Good afternoon, ladies and gentlemen. I hope all of you had good lunch. There are some people, I think, outside. Ladies and gentlemen, if all those who had your lunch outside, may I request your presence inside the auditorium, please? Can we have all the delegates inside the auditorium? Yeah. Thank you. So, we are moving on with the next session, which is again a very special and an interesting session. Cash flow optimization, a CFO's guide to sustaining growth and economic challenges, amid economic challenges. So to drive this session, we have Mr. S.V. Krishnan, is whole-time director and global CFO, Redington Limited. May I request Mr. Krishnan to take his place on the dais, please. May I have the AV of Mr. Krishnan, please?
Mr. S.V. Krishnan is the whole-time director and global CFO of Redington Limited, with extensive experience in financial management, strategy, and risk compliance. He played a pivotal role in Redington's growth, including its 2007 listing in India. Prior to joining Redington, Mr. Krishnan held key financial leadership roles at Ashok Leyland, demonstrating strong leadership and cross-functional collaboration skills.
May I now invite Mr. Krishnan to share his thoughts with the delegates, please.
Okay, thank you. And first of all, I need to thank Mr. TGS and Captain for inviting me to this session. I am conscious, I hope that's not conscious from the organizer's perspective, that this is a post-lunch, within quotes, graveyard session. And if I look at the agendas for the day, there are topics like digital transformation, the new accounting standard norms that are coming up. But this is an area, cash flow, which I'm sure as finance professionals, each one of you had gone through for years in your day-to-day job. I need to admit I'm nervous how I am going to keep you awake. Yeah? Okay. So, cash flow, while, food is important for us, the cash is highly important for success, running, and if I may say, even survival of a business. It so happens that, we take this for granted. Anything which is fundamental, as we get used to that model, we assume this will exist forever. But if you study various, even large corporations that had gone belly up in various situations, various time periods, you will find a connecting link majorly that there is a mismanagement of cash flow. There is no proper focus on the cash flow. Had that been in place, maybe they would have continued as we speak now. So, my only submission and request, I will also be taking you through on some of the slides on the same topic. This is something which is fundamental as to how veins are required, blood is required. It's like a DNA for an individual. Cash need to be there for any organization. And it is our responsibility as finance leaders to make sure this is properly nurtured and protected, which ensures the survival of the organization. How should I navigate? Any business leader or an entrepreneur, if you talk to, there are certain premise which I'm sure each one of you will be able to relate to, that you would have heard from the constituents. The profits are far more important than anything else. Profit is the key. If you make profit, the company is successful. If you grow profit, the company is regularly successful. If it's not successful. While I'm not discounting anything, but let's move on. If you are making consistent profit, financial health is ensured and secure. I'm growing year on year. My customers are happy. What else this thing I need to do? I'm sure the company is going to exist forever. I have invested in a state-of-the-art facility, and I feel the future is mine. The capital structure is properly there. We have enough capital, and I have far more debt capital, which is the cheapest mode of raising capital. So what else is required to make sure that the shareholders' wealth is ensured? I measure the senior management team just on simple metrics, either the revenue growth or profit growth or both. These are standard common statements we keep hearing from various constituents. Is this true or is this a myth? If it's not true, not entirely true, what is this, fail-safe method that enterprises need to ensure that they are able to continue for a long period of time? This is what various business leaders and the thought leaders have been saying. This is what Warren Buffett has said. He said cash flow is important for him to assess the intrinsic value of any asset. And he also says he makes investment because there is cash flow. I need to tell you here, not many would know outside, 15 plus years back, Berkshire Hathaway, the firm, being run by, Warren Buffett, was evaluating an investment in Reddington. Did not go through because he felt, and his next in line by name Arun Jain had said, we are not able to see consistent cash flow in the business model, and sorry, we are not ready to invest. But I need to tell you, the same Berkshire Hathaway made a bid for one of our global competitors many years later. Assume Warren Buffett had invested in Reddington that time, it would have been his first investment in India, and this is about 15-16 years back. And that decision was primarily taken because he had felt the business model does not automatically lend itself to a free cash flow all the time. Richard Branson, very, very interesting statements. He says, this is the lifeblood of any business. And he also says, a business cannot survive if it has not enough cash flow. And then finally, a business can have high profits, but still it will have, if it has challenge in the cash flow, it cannot be a successful business. Steve Jobs, only through cash flow, investment in the future can get ensured. These are statements from wise people, experienced business leaders. For Jack Welch, of the three important metric on which he drives, he drove the company, the financial metric in that was cash flow. Michael Dell says, you can't drive a vehicle by looking at the speedometer. You need to ensure that you have sufficient fuel, right? And similarly, I can go on and on. Every business leaders, every financial experts had very clearly, categorically had said cash flow is supreme. If they need to make a choice between multiple metrics, cash flow, it would come on the top. It doesn't matter whether it is a startup concern, small organization, medium organizations, large corporate, conglomerates, multinational, homogeneous market. Now, let's get on with what is this cash flow all about. Let's understand what are all the different terms that are there, how these are interlinked, which is important, which is next down the order. If there is a challenge, how should we manage these cash flows? Just some basic metrics. I'm aware many of you are experts in this, but this will set the context in terms of what we are talking about, and then we can get on with what we would want to do. First is the cash profit, right? So the profit that we make in cash, simply it is, the book profit plus any non-cash item is basically the cash profit. This gets changed every day, right? You may say, I'm not preparing the books every day, but as the business transaction happens, the cash profit in the business, it changes. So if you start monitoring your bank balance, you will know, subject to various elements, adjustment that you need to do, what is the cash profit that you make. Second, the cash flow from operations or operating profit. Here, you need to add the changes to the working capital. If you are taking a period, the opening working capital vis-a-vis the closing working capital, the change, if you adjust, it will give you what is the operating cash flow. This operating cash flow, it tells you on the day-to-day running of the business, how is the cash flow movement? Is it healthy, not healthy, and for what period of time? This takes you to the next cash flow, which is investing cash flow. This doesn't happen every day. This doesn't change every day. The first two, the cash profit and the operating profit, changes every day because it is to do with the rhythm of the business. The investing cash flow is more to do with you buying a property, divesting a property, buying an asset, creating a business facility, infrastructure. This happens maybe a couple of times in a year, but you need to have a line of sight. What is it? When are you going to invest? What is that amount? Or when are you going to get the sale consideration? So this is something which will help you to plan for it. All these, and this takes you to free cash flow. So the operating cash flow adjusted for investing cash flow gives you the free cash flow. This free cash flow is what every constituent calls it as cash flow in general. If you need to evaluate a company for a period of time, what is being spoken about as cash flow is this free cash flow. And this free cash flow can have surplus or also can have shortage. This need to get bridged. How it will get bridged? That's the financing capital. That's the financing cash flow. That you will bridge it in the form of raising capital, raising loan, or you repaying the capital or giving dividend in all those forms. If you adjust for this, what you get finally is a change in the cash position that's there for a given period, right? Here is where the source that we will be ensuring during the financing cash flow period, it cannot be vary. There has to be a specific model that should be in place. So you have to understand whether the cash flow shortage or excess, is it short term? Is it medium to long term? Is it sustainable? Then the sourcing has to be in that form. If it is short term, then there are short term loans. If it is medium to long term, or that's the way it is going to be, for the foreseeable future, it can only get bridged either through a long term loan or equity capital. So this basically is the model as to what are all the elements, how these are related, and if there is a shortfall, how should we manage this? What is the success mantra to ensure that these cash flow is properly in place and we are focused right? First and foremost, internalize and socialize that cash is the king across the organization. This is something which is very important. I can just give you an example. I mean, Redington today is a $11 billion company. It's about 90,000 crore turnover for last year. At any point in time, we have about 15 to 16,000 crores money invested in the business across about 40 markets. For us, internally, go and talk to any constituents, the business or the sales and other key leaders. I have my colleagues here, this thing amongst you. They all will tell you that this is very clearly internalized. It's internalized in the form of how do you use the working capital. Because in our business, about 96-97% of the capital is in working capital. So the easy metric to track is how much working capital do you use? Each one in the organization tracks it. His performance is evaluated basis how he or she does in that segment. So it has got internalized. Only if it had got internalized, some of this can get driven. It cannot get driven from the top all the time. Amongst various metrics, we say profits, revenue, hygiene of the balance sheet, or various ratios, return ratios, gearing ratios. What is important? What will give you the comfort? Not the only comfort, but comfort that directionally you are right is the positive cash flow. If everything else is a tick mark, here you have a challenge. Be rest assured that you will come to a situation where you will say, I have only 5, 6, 10 months of cash burn. You have to have projections. One is tracking cash flow as a status update on a particular day. Second is you need to project the cash flow for a given period so that you have again a line of sight as to how things are going to unfold, when you should organize what type of funds, and then you can start negotiating and then sourcing at whatever optimum terms that are possible. So this has to be in place for a given period. Normally what is advised by financial experts are 4 rolling quarters. You may say 12 months, right? But some constituents, some businesses might say, mine is a seasonal business. I cannot this thing project it for a year. The barest minimum is for a quarter. Any organization, small or big, if they say, I don't know for the next 3 months, what is the cash flow position of our company? That's something that's not appreciable at all. As I've said, internally, you have to make sure there should be ways and means of goaling individuals on the cash flow in some form. As I've said, it can be as a working capital component, it can be basis the collections, but you need to have some metric of the internal business leaders to get linked to the cash flow. And what is important is also if your profits are lower. If your profits are higher, then you can do modifications in the business as it goes. If it is lower, lot more discipline is required to make sure your cash flow is in a proper position. Similarly, if your business is highly capex oriented, or if it is highly working capital oriented, again it requires you to plan in a very disciplined form so that you are ready. If for any reason you get into a challenge, there are various ways in terms of addressing this. You can say, I would want to collect from my customers faster. I would want to delay, or I would want to negotiate better terms with my suppliers, or I would want to liquidate the inventory as fast as possible. I can tell you this something that we had learned in the business. If there is a channel partner, if there is a customer who sells consistently at a loss, it's a very clear indication of his cash flow challenge. Because he wants to make sure he get the cash. It doesn't matter at what price he sells and whether he is making enough profits or not. So, you have to ensure if there is a challenge, some of these actions are complementary. You have to decide what is good at that point in time, but make sure that cash shortage is not visible. I'm not sure how many of you would have gone through a cash flow crunch in the organization. I can tell you it is a nightmare. I know a lot of finance leaders who had said, I want to move into an organization of this type only because I don't want to get into this challenge. Right? And it is our own creation as finance leaders. We are here to advise, caution the management as to what is right, what is not right, and what is the Lakshman Rekha beyond which things cannot get allowed. If that governance is in place, I'm sure that situation would not have happened. How can we on a steady state basis optimize the cash flow? I think this is something which is fundamental and we need to ensure in our own way, day in and day out. Break down each smaller components as possible, but the barest minimum is the working capital components of how much inventory you have, how much AR you have, how much AP you have, how much free float you need to have. All this need to get defined and then planned. If you are present in multiple markets, do it by markets. If you have multiple business verticals, do it by business verticals. If you have multiple branches, do it at the branch level. As minute that you can go, then the planning and operational effectiveness can be better. And in aggregate, even if one or two or a couple of units goes wrong, it doesn't disturb the entire scheme of things. I'm just giving you again an example from Redington. Redington deals in 40 markets. We have about 230 plus brands. Within each brand, you say HP, you say Apple, you say Cisco, each one has multiple product categories. Apple has an iPhone, Apple has an iPad, Mac. So, our profit center, our monitoring of every metric up to the level of working capital, each of the component of working capital is at this level. So, there is a Saudi Arabia. Which in Saudi Arabia, there is an Apple iPad business. Within that Apple iPad business, while I have revenue and everything on the P&L, I also know how much AR is there, how much inventory is there, what is the norm, am I within that, am I outside of it. That allows you to plan it better, right? Because you know where there is an exception and where you need to monitor. Next, always keep forecasting. That forecast will give you a perspective about how things are going to be, and you need to bring in a lot of business elements. As I've said, seasonality, January 20th, all of us know there is a big world event that's going to happen. That's a different gorilla by itself, right? How prepared are we? Right? So these elements need to be brought in so that we know what can be the step, plan A, plan B, etc. Seasonal business like an agriculture, sugarcane, or it can be tourism. So there are peaks, there are troughs. How do you plan for the cash flow during the peak period? And how is it when there are challenges in terms of demand? Another advice, while I'm sure this is a debatable point, many constituents will say this leads to inefficiency, but you also need to be prepared for a black swan time, right? You don't know in what form it will come, when it will come. There is a COVID moment, right? All of us faced in the month of March 2020. What this means? We didn't know how that will unfold. While it is a history today, at that point in time, we really did not know how this will unfold. And each one of us, as organizations, have faced these situations, right? So it's important you create a contingency amount and then be sure some of these exigencies are handled through the contingency reserve. How should we navigate the challenging environments? There can be liquidity crisis. The global financial crisis that happened in 2008, as I've said, COVID, everything got shut. Again, if I need to take an analogy of Redington, as I've said, imagine 15,000 crores of money, either in inventory or receivable from about 38,000 channel partners spread across 40 countries as far as Nigeria, Morocco, Algeria, Turkey, etc. How would we plan if there is a lockdown? How would we plan if there is a shutdown for a couple of months? Which customer is going to pay me? Right? This was a moment which allowed you to plan better. And these type of liquidity situations will keep coming. We did not know that Bangladesh government will get toppled in a few weeks' time. We did not know Syria will get toppled in a week's time. How prepared are we? Right? We knew having businesses in these places, at a point in time, you will have a 50, 60, $100 million money struck. How would you take it out? I mean, what happened in Sri Lanka, all of us know. What happened in Pakistan, all of us know. Right? I'm talking economically. How do you prepare yourself? And this is a management by itself. Yes, we have managed it, but that doesn't guarantee that we will be able to manage it in future. That requires a meticulous planning. How can we do that? So, on the Redington example, as I've said, at that lockdown moment, we sat, we were talking about how should we manage the situation. First, we said, 3 months of our regular expenses, we will keep it in a bank deposit. Even nothing happens, for 3 months we are able to run the show. Beyond 3 months, we don't know, we will see it as it comes. Next, we said, we will borrow all our limits from the bank. It doesn't matter if there is a negative carry. So there was a team that was put in place to make sure that whatever borrowing that we can do from the bank so that we are able to pay the vendor. Would an Apple or a HP be willing to not collect on time? We thought they may insist. So we had also prepared for the cash. We also negotiated with our vendors for extended credit terms. As it was a global situation, we did find many of the suppliers, many of the brands did agree for it. Similarly, we also took effort to collect the invoice outstanding from our customers well ahead of time or on time. All this, it clicked fortunately for us. We have not had a day of cash flow challenge even during those 2-3 lockdowns, which were in varied degrees across various countries. And these are some moments which will help you to understand how meticulous you are in terms of planning for some of these exigencies. Similarly, interest rate hikes, what we had seen in the last 2 to 3 years. In our Middle East and Africa business, our interest rate was sub 1% for more than a decade. Sub 1%. Ours is a 1.3, 1.4% margin business. You can imagine what this would impact. That interest rate went up to about 6.25%. Right? It's now coming down. It's expected to come down. But a 6 times, 7 times increase. As we speak now in Turkey, the interest rate is 50%, 50%. You have a 1.2 billion dollar business there and you need to manage. How would you do that? So, there are interest rate cycles. You need to know if there are such situations where interest rates are going to go up, there will be tailwind if it's going to come down. If it's going to go up, how are you going to manage the show? Right? You have to go back and talk to various financial constituents and then see whether you can renegotiate some of the terms, or can you increase the number of financial products or sources so that you can make a choice and reduce the cost or the terms. This is something that we need to do on a consistent basis. Similarly, inflation. Again, the interest rate went up because the inflation was consistently higher. It doesn't come down in many places as we speak now. How would you manage those situations? You might ask, how is an interest rate and an inflation has any relevance to the cash flow? Everything will finally come to the cash flow. When we say cash flow, what does it mean? All the cash inflows and the cash outflows need to get properly managed so that there is no disturbance to the core business. That's why I said this is normally being taken for granted. And at the same time, you get the best out of that cash flow. Right? So when the inflation keeps going up, all your costs are going to go up. That require fragility in terms of managing your OPEX. Geopolitical conflicts, as I've said, in Bangladesh, in Syria. You need to have alternate methods. When do you want to wind down the business? When do you want to downsize the business? Wind down decision is easy. Exiting decision is easy. I'm sure as leaders you will know, getting into a market, getting into a new business vertical, how difficult it is. So you can't exit, right? But you should still function without less bruise. How can you do that? Is an action by itself. Similarly, there are significant slowdown in demands. How do you adjust, realign yourself? Make sure that your short-term and long-term goals are not compromised, right? You need to protect your core. You need to protect your turf. You cannot lose the market share. You can't say, I am losing market share because I'm not able to maintain the business profitably with sufficient cash flow. So the fragility is highly important in volatile environments. And we just need to, as finance leaders, we need to be prepared, because what happens on a steady state basis is taken for granted. Our role, our importance comes in when there are disruptions, when there are one-offs. There are some large transaction that's there and the business leaders want money. At that point in time, to go and source for the money is more a reactionary approach. How do we preempt that? Ensure that we have multiple sources and then we are able to execute when there is a need is the crux. Finally, just to summarize, please remember, we always top line is vanity. We all keep talking about what is this company's revenue, that company's revenue. It's vanity. Bottom line, the profits are sanity. It is better, but that's not the end of all. The reality is cash flow. In other words, in a cricketing analogy, revenue is like a rubber ball. You drop it, it will come back faster also. The profit is like a cork ball. It can come back, and definitely not fully, but it can come back a bit slowly. The cash flow is like a glass ball. If you drop, it's dropped once and for all. You are not going to get it back. Thank you. Over to you for questions.
If there are any questions, you could just scan the QR code and please send it. There are already some questions online. First, let him take that.
what role does technology play in the cash flow optimization, and how can CFOs leverage digital tools to enhance forecasting and decision making? Interesting questions. In fact, this is something that in the new technology world, we all need to be aware of and be focused on. See, as I've said, the cash flow forecasting is something which is fundamental. All the businesses, I was meeting someone who said our business is 50 years old. And someone said our company is 130 years old. There is a lot of history to every organization. Where are we capturing this history? Where do we observe the trends, the patterns to derive a decision-making principle? I think it's very important. How did a customer behave? How did a business function? How did a branch behave? How did a branch manager behave? All this information, the past data is there in the system. And there are a lot of predictive analysis that are possible in the new scheme of things, big data analytics. So you will know with the current trend and the expected events that you may put into the tool, what is the expected cash flow into the next immediate period or for a longer period. And then you can decide, can I map this to a short-term loan facility from a bank, or should I need to go back to my shareholders? If you are a listed company, it's important that you define upfront what is your dividend declaration policy. You have to state how much you want to declare as a dividend, right? So how would you decide it without knowing what's going to happen in the future? So you have to calibrate some of these decisions basis what output that you get as the cash flow item. So you have to keep track of some of these technologies and tools and then see where you are. Does this answer your question, Vishnu? Yes, sir. Oh, these are online. Okay, good. Thank you. What strategies can CFOs adopt to optimize cash flow while balancing the need for investments in innovation and long-term growth? Very, very interesting question, because I need to tell you this is a constant debate that happens in the external world, even amongst the experts. Is growth important? Cash flow important? It is a simple math for us to know that even in a very mediocre business, if there is a degrowth, you will have positive cash flow. Don't get easily carried away that things are perfectly fine. At the same time, there are businesses which requires additional investments because you see growth. The metric there, first of all, cash flow being important is not diluted. That's something which is fundamental. Having said that, if whatever cash flow that you get from the business, which I had said, the free cash flow, if you are able to deploy for returns better than what the market would normally expect, I think you have every right to plow it back into the business and ensure growth. That's a conscious decision that you are taking at the time of dividend declaration, because you feel like there is a need for me to deploy capital to give them a better return. If it's not, I don't think we have any right to sit on that cash. You have to give it back to your shareholders. So this debate on growth and cash flow will always be there. You have to make a choice. This doesn't take away the importance of cash flow. In an environment of economic uncertainty, how can CFOs effectively manage working capital to enhance operational resilience and sustain growth? I think this was broadly covered in my deck. You have to keep planning. See, today, valuation is not on past performance. Valuation is on future performance, right? And we as leaders, we are supposed to estimate, project, and prepare a model. And that could be for various purposes. So depending on it, if you are a listed company, it's important, you need to tell your constituents how the quarter will look like, then become short term. If it is a question of you going and pitching for additional capital, and you want to give a this thing perspective for the next 5 years, you are supposed to this thing project for the next 5 years, right? With whatever estimate that we can do, which are within quotes the best judge estimates, you have to you have to take a view. Bring in all the elements of surprises that you can think through. What is a very clear unknowns? Sorry, you can't, and that's where I had suggested, should you need to keep a contingency reserve, and how much need to be the reserve? That's an independent subject by itself. But for a normal business operations, it's important that you have to look at various variations that will happen and then project the cash flow so that you are very well prepared.
Thank you, sir. There's one question which has come, somebody has scanned it and sent it from here, the hall. The question is, in startup world, though there is no cash generation by business, they are getting rich valuations. Any comment on this?
This is a new world. That's why I said, if you go and talk to any startup companies, they will say, I have 6 months cash burn, I have 10 months cash burn. What are you going to do? They are at that point in time, they're blank. But the thing is, see, the rhythm of every business is different. Some are volatile business, some are in the nascent stage, can give growth in a very short period of time. It's important, you need to know where are you, and if assume you have a situation where in about 10 months it's going to be a cash burn, at least for next 10 months the business can go on a steady state. But there is a time, 2, 3, 4 months down the line, you need to start the effort in terms of making sure the fund availability is in place so that your business continues. Valuation, no compromise, and that's something that is the IP of the business, that's the purpose of the business. By nature, startups in the initial phase cannot give you a positive cash flow, but this is the way I think it need to get managed.
Thank you, sir. Ladies and gentlemen, I think Mr. Krishnan deserves a big round of applause for a very for an upfront and a very thoughtful presentation that he made. May I now request Mr. T.G. Suresh and Group Captain Vijay to come and present him with a memento, please. So may I request you to accept a memento on behalf of MMA and Mr. Suresh. Ladies and gentlemen, we are moving to session 5 now. Session 5 is again a very interesting topic. CFO as a change leader in digital transformation. And to drive the session, we have Mr. Jagannathan Chakravarti, CFO, Sonata Software. So, may I request Mr. Jagannath Chakravarti to occupy his place on the dais, please. Let's welcome him with a round of applause. May I have the AV of Mr. Jagannathan, please.
Mr. Jagannathan Chakravarti is the CFO of Sonata Software, overseeing the company's financial strategy, M&A, financial planning, and capital structure. With a strong focus on business growth and governance, Mr. Jagannathan drives shareholder value through tailored solutions and automation initiatives. His expertise in financial operations and technology integration has been key to fostering sustainable, profitable growth at Sonata.
May I now invite Mr. Jagannathan to share his views, please.
Okay, thank you. Hi, good afternoon all. Thanks for inviting me for this session. It has been a long time I've been in Chennai now. After many months I'm coming to Chennai. It's very always been here all through my studies and started my career here. Always I studied with sir only as a student. So when this invitation came, I thought this is a good opportunity for me to connect back to Chennai. Been quite while now connecting back to this old my city. Still fond memories of my city. Coming from Bangalore, I initially thought I'll join over the digital media, but then I decided let me make it happen in physical so that I can meet people also. This is a good opportunity for that. Thanks for that again. So this session is a little difficult timing. For us, the major difficulty has been handled by SVK, so he managed it quite well. With his lot of energy talk, he was able to keep you all awake and alive after the good lunch session. So post lunch session is going to be always a difficult challenge for all the speakers. So coming to this digital transformation, how CFO plays an important role. So what do you people think? I just want to hear from you people. What is that CFO's role in the digital transformation? What do you people think? Why should CFO play a role in this? Cash flow, yes, relevant. CFO has to play a role. Governance, yes, CFO has to play a role. Accounting, compliance, business finance, everything CFO has to play a role. Value creation to shareholders, yes, CFO plays a role. Digitization, what is the role of CFO, do you people think? Why should CFO play a role in this? Anyone, please. Okay, how does money relate to digitization? You can make money without anything. There are enough of business in India where nothing is there. Still they use in the back of the envelope paper to do business and make crores of rupees, even today in India. You can run balance sheet. Excel, maximum digitization. Even today, Excel is the best form of system. What else? What is the reason? No, that's fine. Why should CFO play a role in that? CIO is there. That is what we think. Business doesn't think so. These are our myths. We are still enabling functions. Don't have this view in mind. No, wherever money to be raised, CFO can play a pivotal role. People like our company, IT companies, we don't need money. So where is the finance role then? Business can do on their own. Most of the IT guys are very good in finance, I'm telling you. So, I want some more views. That's a very valid point. One of the valid points for us, because after the CEO, the responsibility as a KMP is one of the major role is played by CFO. So he has to ensure not only the business performs profitably, there is a governance, there is a compliance on regulations, as well he has to ensure that the shareholders' interest is protected. So CFO plays an important role. Okay. That's the point. So that's an important point. The data, business is driven by data nowadays. Without data, nothing is in the world now. So with this data, data is the next oil. When our new company started, they made a statement saying data is the next oil. So data is very, very key for any business now. So that major amount of data is with us. That's the reason why CFO plays a very, very important role in digital transformation of a business. Okay. So this is the key. We have to understand why finance plays a role. Other than that, don't have a myth that CFO is a co-pilot. We tell ourselves. Okay. The business will know how to run themselves. So you have to make your own value creation for the business. That's a secondary thing. Definitely CFO plays an important role, but that's not the only thing. The main reason is because you are the main holder of the data in the organization, and that data is very, very key for all the digital transformation and business decisions. So let's get into that, some of the discussions on why CFO plays an important role. So I want to take the first center point here, why digitalization plays an important role in any business for that matter. Before getting into all finance operations have to be handled and all these things, before getting into that, the important part in this is the decision making in the business. So all kinds of decision making requires some amount of data. In the modern industry, any business you take, we spoke about startups, right? Many startups run completely on some amount of data. Without data, nothing is decided. I have seen many cases of decision making. Even Harvard Business Case Studies cover how intuition plays an important role in decision making, right? So that all of us have read that intuition plays an important role. Many leaders take an intuitive decisions on business. It is no more the case. Any decision making which is related to business bounding has to have some amount of data. Any decision making for that matter. I'm purposely stopping here because decision making data means all of us think that what is the revenue, what is the profitability, what is the gross margin, what is the EBITDA for the business. I think all the discussion happens on that now. It can be any other data also. I'll just give you an example. All the international companies like us, for us, the diversity, sustainability and diversity is a very important factor because most of our customers want it. If I don't have that, many customers will insist on that, and I can't do business without that. I have to showcase my diversity in all the places. If I start doing a diversity, how will I measure the diversity performance? Immediately number comes into play. So diversity has to be first not only men and women, it can be multicultural, multi-country, multi-location, anything can be diversity. So for each of these elements, we need to bring a number there and then have a plan for it. The plan will have a number, plan will have a target, plan will have an owner, plan will have a time frame. All what is measured is managed better. Famous Peter Drucker told that is what the current business is all about. There is no business decision, just a small area of diversity will have numbers into it. And any decision making in any business for that matter, without number, no decision can be taken. Simple, he was telling about cash flow, right? If some cash flow question comes to me, I want to spend $10 million as a new entity we are starting in Egypt. I want to invest $10 million there. The first question is not, I will not say yes, no immediately. Everybody knows what is required for me. The first question will be, what is the revenue? What is the 3-year plan? What is 5-year plan for you? What is going to be the margin? How much headcount we are having? Who is the customer? Who is the anchor customer for us? How much of cash flow will come? This $10 million, how many days we will run the business? So the question is, all these things have to be converted into a number. If this number is not there, then decision making doesn't happen. Even I have spent 2 decades in IT industry now, more than 2 decades now. But still I don't take a decision so easily on any of these things without numbers. Because that's a key core area. If you have to have this number or a data on this, you definitely need a digitization of the entire business process to get the data. The success of a company and the not so successful of a company depends on the digitization only. If at all, any of us in the business today in Sonata Software, if you ask us, what is the biggest challenge for you? Our IT system is not up to mark. We are struggling. And anybody and everybody, any organization for that matter, the best of the organizations, still they say that my digitization is not enough. I'm still struggling. There is an interesting case study on this, on the digital economy. All of us know Asian Paints. Asian Paints is one of the companies who had digitized far ahead of all the companies. For example, if they want to know this 1,000 lathe tomorrow, how much is who is going to be the stockist of their paint, what color paint they want, what brand of paint they have to keep it here, how much quantum they have to keep it, they will not ask the distributor. They will decide, even the color of the paint. How? Data crunching, data management, digitization of the process. They have implemented the system some time back to have a few beautiful decision-making process in this. I was talking to somebody in this IT function in Asian Paints, and they were saying my digitization is not enough. I was thinking, then what will I say? Doing P&L, preparing financials is not digitization what I meant. What is digitization is the entire business process end to end has to be in the digitization where we are able to capture all the data live. The question for us anytime comes to me is about the headcount. IT companies depend on headcounts. So any day, every day, what I look in is how many people have been added today, how many people have exited today. This is one information that has to be there with me every day basis. Because I have to keep a track of how many people we are adding, how many people are exiting. Are we having enough of bench? Because if it is not there, we will lose the business opportunity. So entire process right from hire to retire, opportunity to cash. Earlier we used to call order to cash. Nowadays no, opportunity to cash. Procure to pay. All aspects of the business has to be digitized. Means it should be in the flow of information system. If not, I will not be able to run this. Why is that? Headcount data cannot be right. If the hire to retire process is not in the system, I will not know how many headcounts I'm hiring, how many headcounts are leaving. Very recently also it has happened. Some time back, post-COVID impact. Somebody has resigned. They have sent the resignation in the email. Our HR team has received. They have also shared with the offshore team in email. Not in the system. It didn't go to the payroll person. "18 months, 36 payroll cycles. The guy has got salary in US. What will I say? So this is not a small money. One person has got so much of unfair enrichment. You know one thing? That guy has taken $350,000. My legal team came and said, to sue him, I need $300,000 budget. This is all the impacts of digitization. If you don't have it, you are going to pay a hefty price. So all decision making and the financial operation alone, not HR operation also in an IT company, HR operation is very key. We need the digitization there. If it is not there, you will have problems like this. In small cases of information, what sometimes digitization creates enough of troubles for all of us also, right? When government decided that all PF account has to be linked to the Aadhaar, wonderful. Lot of security, okay, fine. You know how many people could not get Aadhaar? Because they have name mismatch everywhere. For people like me, I had a problem. My name was Jagannathan CN till I finished my CA. Suddenly it became Jagannathan Chakravarti Narasimhan later because after IT industry needs everything expanded. My Aadhaar had one, my license had one, my passport has one. It did not match. I can't get Aadhaar. If I don't get Aadhaar, I can't have PF. If the PF account is not there, how will I remit money? It has penalty. CF regulation says CEO can be arrested. What will I do?
So,
It's
just
a compliance issue.
small announcement. Someone with car 7194, an Audi car, I think there is someone else wants to remove the car, sir. Just 1 minute. So please continue, please.
So these kind of digital can create trouble to us also, right? But the regulation is regulation. I have to comply with the regulation. So to meet the regulation, we have remitted the money to suspense account. PF department, if I remit to suspense account, it has gone this account. You can't correct it at all. The employee is jumping and PF department is not agreeing. Daily headache. If you would have done that digitization after properly validating that, there is no issue, right? All of us know when the GST was introduced, how much of reconciliation people have done. No, lot of chartered accountants started a reconciliation as a service, right? So always digitization has to be smooth and then flowing of digital happens, particularly in all the business operations. I will not say financial operations, business operations. Every aspect of business operations needs to be digitized. If not, data is not captured. If you don't capture, I said in one particular area, if digitization is not there, you don't bring into the system, what is the impact of it? Just one person not for putting it in the system costed us 300 plus 300, $600,000. Just one person. So the question is, the holistic flow of the business has to be seen in the way the systems are framed. This is where CFO plays an important role in this. The reason is because all of us have understood the internal controls, process flow. We know what is that coming in. So we should be able to design the process which is actually giving the full capturing of business transactions. If it is not there, we are going to pay a price for it. The other one important aspects to that, what I have seen is, the digital transactions can become complex also. There are enough of troubles in digital transactions, which has created enough of problems I've seen in my life, many, many times. So the problematic places of digital transaction is, for example, you will have a refreshment of system happening in the midnight normally. Many places where the volume of transaction is very high, we used to have one cycle running in the midnight so that it updates all the system data from the front end to the back end. This update sometimes can create trouble to us. I've worked in a Bharti Airtel. The cycle will run at 12 o'clock. We don't know when it will run also. Normally it is 12 o'clock, it can be 1 o'clock, 2 o'clock, 3 o'clock, depends on the IT person's mood that day. anything before that and anything after that, the balance itself will be different and you will get lost in reconciling the transaction after that. So these kinds of challenges will happen in any kind of businesses for that matter. So what is happening, how it's happening, what time it's happening is very, very important. And it can create a complexity of its own. Particularly in the newer areas, what can we do with digitalization? All of us know IT, ERP, front end, middleware, back end, backup, cloud. All of us know that. What are the innovation that can come in this? We know that Gen AI has come and now it is playing an important role now in all that digitization. How can it bring the changes in this? At some point of time, Gen AI can replace many of the financial accounting process for us. It is going to happen not very far away from now. It can create a challenge to all of us and many of us because it can bring a big transformation to us. As an organization, we should have the strength to know the innovation, what it can bring in and how to adopt it ahead of time. At present, we all use ChatGPT only for things which is very, very normal, basic things. I don't think any of us are still using it in a large scale. Of course, preparation of a PPT, preparation of a job description, or many questions we use that. Some analysis is possible, but it is far, far ahead of this. It has lot of features which can be leveraged by organization in a multiple ways for it. For example, we have created like a vendor creation. You have to have a PAN number, you have to have a GST number, you have to create the vendor across the global, you have to go get the backup document about him. So all these things with the basic element of scanning, the Gen AI can create a vendor on its own. So this is a very basic process for us. For example, for HR policy, we have a chatbot which is a Gen AI based chatbot in the teams of every employee. If you go ask any policy, it will give you the policy immediately. You put it based on your login ID, it will select which geography you belong to and what is the policy you have, and it will share the policy to you. So there are multiple usages of innovation possible with Gen AI coming in. Then the costs of digitization itself can come down in the coming days. At present, it's not a cheaper option for us. It was very fancy for us, many of us, to use the word cloudifying. Everybody thought everything will be in the cloud. The world's business, about 30% of the business have gone into the cloud. But now, many companies in Europe are reversing the decision, going back to DC and having the dual mode of DC, physical DC plus cloud. For the average cost will be lesser for them. So if Gen AI comes in, probably the costs of the digitization for an organization may come down. And that is what is expected, and it will take some more time for us, some more time for understanding the nuances of it and how to apply it. It will take some more time for the world to innovate that. But it can bring in a dramatic amount of cost savings. IT industry, all the coding is supposed to be replaced by Gen AI. So my daughter was telling me, she just finished her postgrads in London. She was telling me, Dad, when I was studying in 6th standard, 7th standard, you used to say you have to read tables. You have to know that table, you have to know this table. Why should I know? I don't need it. I can program and find out everything. I don't need any of these things. I told her, why should you program? Gen AI is going to create that for you, all in your fingertips. Will it make man intelligent or not? That's a different thing. But definitely there is a tool coming in which is going to replace everything. What was very, very fundamental for more than 100 years as the basic part of education, till our generation has changed for this generation. It is now more relevant now. All the formulas in mathematics, all those things done. Now the kids, you know what they do? Max problems. They go take a Google Lens, capture the problem and it gives an answer. They don't depend on anybody. They don't come and ask any teacher. They don't ask anyone. Just scan it with Google Lens. It gives you answer. The way the digitization has happened in the life of people have changed now. And government has been in leading trend. That's a very important thing. All of us never dreamt that a GST regulation is end-to-end digitized now. Income tax has been digitized. Everything is now digitized. Government is ahead of all the organization now. The other important point is about forecasting, right? How AI can play a role in forecasting. I want to hear how many of you are very saying that you are able to forecast the business at 98% accuracy. Can any one of you confirm that you are able to do 98% accuracy forecast now? Where is the forecast? What percentage you can say? You know, political parties, they do much ahead of us. They know the result ahead. Most of the decisions they know. One of my ex-colleagues, she was working in one of the party, national parties. Most of the decisions she knows. She knows this will be the result. Very, very less period of time that she has not been correct. Most of the time she has been correct. When they are able to do forecast, why not we? I still remember, it must be in 2016, I think. In one of the quarters, I'm presenting the financials. So board asked me, what is your outlook for next quarter? I said, very uncertain, I don't know. They asked me why. Because of a lot of uncertainty, I'm not able to predict. I'm not able to give a forecast. Lot of uncertain factors are playing in this. They blasted me left, right and center. So I was fully dull. Lunch, they were all sitting together, board was sitting together. I sat separately. The ex-chairman of Coffee Day, Mr. Siddhartha, he was one of the board member. He came and sat with me and he told me this story. Again, I also have the same problem. You also have the same problem, forecasting the business. But you know the political parties, they do much ahead of us. So all these things happen with the digitization there. So the CFO has to drive this to ensure all business transactions are digitized, not for anybody's benefit, for our own benefit. Because we have to forecast the business. We have to ensure the compliance. We have to ensure the governance. We have to be able to say what is the risk in the business. Many people will not understand that CFO's important role is foreseeing the risk in the business. SPK was covering about various black swan events. Forget the black swan event. Even a normal flow in business, how much risk it is there? What kind of risk it can be there? And tomorrow the business can completely fall flat if you are not ready with the risk management for yourself. What is customer expectations? International customers' expectation is that you are able to give the confirmation on all the revenue related, cost related. Now no customer accepts any of these without the information in detail. I know many customers have asked, I want the salary details of all the employees. I know many customers ask, how did you build the invoice breakup? Or how have you been managing the margins of the business? How have you given increment to people? All these questions are part and parcels of customers' expectations now. And these are all required just 48 hours time. No customer is ready to wait beyond that. If you have to meet the customer expectation, probably you need to be much agile, much ahead of your data, and it has to be possible for people. There have been days where all these businesses will call the finance function and ask you the data. Nowadays, nobody is ready for that. The democratization of data is already there. They all have access to the data. They will take the data. So unless digitization ensures he takes the wrong data, then there is a problem. It's a very recent case for me. Recently, a customer filed a Chapter 11 for us. He's one of the major customer. And there is a meeting between our CEO and their CEO. And the account manager has taken the data and then he has presented. He has missed $500,000 of unbilled revenue. When I raised it, what? You missed the $500,000 of unbilled revenue. Then the CEO was furious. Why finance did not ensure that the system is ready? If the data is wrong and business has taken the data and acted on it, you are responsible for it. So the expectation from customer is you cannot once give the data, go back on data. It talks about the credibility for the business. And no business is easy to handle. You can question. If somebody was telling, oh, CFO is next to the CEO, yes, you can question the business. But they will also question you back. And data is wrong, they will screw you. That day is gone. All hostile situation can be there. If you are wanted to be the master, you better be master in all aspects of it. If you miss it, and no business is ready to accept mistakes so easily. And the reason for that is because there is a pressure on them, right? For performance pressure is there. They have to deliver the number. If you don't deliver the number, it's easy for us to question them and go. But they still have to deliver the number in all circumstances. Improve the operational efficiency. Interesting point. That's what I was saying. Accounting function and operations functions can be replaced by AI soon. Recently, we had a study done by McKinsey. They are saying 30% of finance people are not required. Now my head is breaking how to implement it. It is easy to benchmark and say 30% of people are not required. How will I do? I have to find ways for it. All implementation of digitization, AI implementation, all this thing, it's not only the cost savings perspective. You don't want so many people there. Not only 30% of the people, 30% of the talent acquisition team not required. Ours is mainly hiring is an important function for us. 30% of them are not required. No, there was an interesting case study we have brought in. A technical interview is done completely by AI. It will make assessment, you will do the coding, you do give an answer, it will evaluate and say you are yes or no to it. No judgments. It will give you straight. And a beautiful person like figure is coming in front and talking to you. You will answer, it will give you a decision, matters over, it's AI. No human beings involved. The next is going to be the HR assessment will be done by AI. With 98% accuracy, they are saying it can be done. The character of a person can be studied with these criteria. It will be very interesting to see how much it is able to do it, but there is a possibility. And all the question papers, all the answers are going to be corrected by AI soon. And for an organization, the knowledge bank is going to be maintained by AI. All financial reporting, preparation, statutory reporting, all can be done. It's not very far away. Unless we all gear up to see the impacts of this is going to definitely happen. There is a worry still that whether it is 100% right or not. No, that is actually saving all of us. Still, it is not extend to that. Still, there is some errors. Still, there some mistakes happen. So we are still saved for some more time. But what I have seen in the many business operations for that matter, without AI, there is no one proposal goes to any customer. If that is the case with all the business operations, finance is also one among them. And all these things have to be driven by CFO. It can play an important role in this. And that's the truth. Whatever happens or not, I have a AA mandate on me. Because I handle legal also, it says we have implemented a AA system where you search for any one particular clause you need. You will search thousands of SOWs, contracts, and then get you this clause. This is what is there in this. Now it will give you a source also from where it got. Earlier it will not give, now it gives the source also. Tomorrow it can write legal contracts. And this is the reality of life. And this is what is the role of CFO has to be played. Sometime back, I do the investor meeting many a time. I used to take a laptop, have a PPT ready, all the numbers ready with me in the laptop and answers and all. Not required. Mobile is enough. You have a Power BI in that, you question in that, you create a data lake and create a Power BI from this. And then it can give you all the answers. Any quarter number. 5 years back, what was this June quarter number? 10 years back, what was the number? Everything it will give. And if A comes, it will summarize and give you a comparison. You don't have to carry anything. So going to the next point, the big data analytics. How many of you have seen big data analytics, impact of it? Have you seen anything very wonderful in big data analytics? You know which is the biggest big data analytics in the world? Any of you? Biggest big data project in the world. Aadhaar. Aadhaar is the biggest big data in the world. Government has all our profiles. It's only question of time they will take everything. The more and more you link everything, you will know. They will tell you tomorrow, where are you? It's not being announced outside, that's it. Otherwise, everything can be tracked. This analytics Very interestingly, one of the customer case study, it happened. When a person goes to a shop, when I go to a shop, supermarket, it traces my social profile with my facial and then finds out who am I. Yesterday, sir called and wished me also for my marriage anniversary. I was just thinking how he found out. But now the AI system will find out. With your social profile, it can find out about you everything. Then it says, there is a marriage anniversary for you tomorrow. It will immediately say, there is an offer for this lipstick for your wife. You want to buy? Will any of you refuse? Offer specifically there. You go to a supermarket, stand before a television for 5 minutes. It will read you completely. And when you come to the billing counter, it will say, I have a 15% off on this TV. Please take it. How many of you have seen Amazon? How many of you use Amazon? The Amazon, what you see, need not be the person what he sees. You know that? Amazon does the programming live for each one of you differently. It is different for each one of you. It can be different. Each one of you, what you see as an offer, what you see as a product can be different completely. They live do programming there. And there is a stores in Seattle, very interesting store. You go pick up, put it in the basket, just walk out. No billing counter. Your Amazon Pay is debited. It does billing, everything. China is much more advanced. They do many more things than what Amazons of the world do. But still, Amazon is one live case where the website itself is different for each one of us. Live programming happens. And now they are pushing the AI driven, and whatever you want, you can do this. There are interesting cases in this digitization in business, which is coming interestingly. In South Korea, if you are going and train, many people go and train in South Korea. When they get down in the platform, there will be a digital boards. They will order the vegetables in the digital board, and before they reach home, the vegetable will be in their home. We were thinking it is dream. It's happening for us now. My mom wondered when my daughter first ordered with one of the early delivery system. From my house to main gate where the shops are there, it will take 10 minutes to walk. But the delivery happens less than 10 minutes. She says, why should we go? Order there only. If she is not there, she says, you also learn, order that. Everybody. So the digitization process for us is not in finance alone. Please don't think so. It is for all the areas of the businesses. You have to think digitization in every aspect of the business. Interestingly, it talks about all the transformative outcomes and all these things. You would have seen this. So I am in charge for many of the enabling function, including facility. So last time when my boss came from US, he was saying, I wanted us to be a AA organization, Kevin. Yes, sir, we are doing it. We'll do all things required. From facility perspective, think how can this be a AAR facility? I said, how? Think. A can be a seat allocation methodology. A can be face reader. A can be attendance marker. A can be anything else in the facility. So we have to see how it can be applied in all aspects of the business. So that is where the CFO role comes into an important area, because you know the business transaction end to end. Please think whatever you do, think AI first now. That's a very, very critical area of artificial. Anything we do, can we do use a GenAI there? Can we have GenAI help us to do this? I'm working on a project where, like all the analysts, investors we meet, after the meeting it gives a summary. Copilot does that. We do the recording, upload, Copilot gives me the summary. What was asked, what was answered, everything. I am pushing them, use Copilot to prepare the entire investor deck. I don't need people. And many of the small investors, Copilot can answer. I don't have to. Not far away, it's already halfway through. Maybe in another 6 months it should be possible. So digitalization, what it was pre-COVID and post-COVID is different. Post-COVID is complete transformation. Everything is so much transformed for us. Thanks to the government has taken the initiative for that. Thanks to the investment they have done, all of us have to think digital now in many, many aspects of it. Somebody was telling real-time financial highlights is not possible. So we are not doing a financial every day. When it was human being, yes. But with AI and digitization, that should be possible. I still remember 10 years back, my CEO used to ask second or third, what happened to the P&L Jagat? I'll say, I'm just doing the accounting, book is not closed. Give me some more time. How much is payroll costs has gone up? You say, I don't know. I have to wait for the accounting to be closed. You will say, 30th, you have paid the money, man. Money has gone out. You are coming on second and third and saying you don't know the cost. I used to surprise why he is not understanding. But that is possible now. You can get the data online every day. It is possible. I'm saying no headcount for me. Every day it comes to me. I get a dashboard every day. How many people is I hired? How many people are attrition today? Every day all over the globe I get. Because that's an important criteria for me. I have to know my core business. And the scalability part of it is a very interesting part. Many of us were thinking pipe business was the only way to do it. The platformation business, what people have got, the size of business, what Amazon and other people have grown, is only scalable because of this online system possibility. Where was Zerodha some time back? The volume of business they all do now. The amount of share transaction happens in India now. How is that possible without digitization? Every business, the scalability is very, very important because we all need a digitalization for doing this scalability. Without the system, for example, simplest system, I have suddenly scaled up 150 people in 4 months in Mexico. How will I do it? My system's all ready, so I was able to do the scalability. If not, payroll has to go, taxes have to be paid, social security has to be paid for finance itself. Then HR, hiring, facility. All things is possible because of the online system or no, systems are ready for that. That gives the scalability for any business. I'll cover only one with this, I will conclude that. This is the ROI of the system. Here we play an important role. For every dollar you spend, you have to get a return. And first of all, any decision on investment in IT has to have a ROI calculation for us. If it is not there, all this, it's very fancy to say, oh, I have digitized that, I have done this, I have this, but everything comes at a cost. Investing without the return perspective in mind, you will end up in spending a lot of money and then it will all go waste. You need to have a clear cut view on what is the return you are expecting out of it. How is that going to help the business? How it is going to give you the benefit and growth of the business means profitability. Because you are putting money ahead into the implementation of the system. Legacy system versus new system is another big problem. We all need to be very, very careful about it. If you do a legacy system and a new system implementation together, it can be a big mess. And the data has to be protected also. The other last aspect of it is data security. Now the data privacy is very, very important act, regulation and global. So very key that you have a data protection, data security, very, very important. I have personally faced that issues in my life. In my earlier company, the financial data was leaked in WhatsApp. It led into a SEBI inquiry. I have faced the heats of SEBI personally. I don't know who leaked it. It's a very important compliance requirement. Data has to be protected. One of the largest IT company, they said, during the last 1 week before the finalization of the date, they have a couple of criteria they had. That after the quarter, within 10 days, they will close, the board meeting will be over. Because if you delay that, data can be leaked. They will not allow the people who are doing the consolidation to go home for 4 or 5 days. They will stay in office. As a mark on a lighter note, as a mark on security, they will put up 2 security guards with AK-47 in their room in front. That will not work. That's a different thing. So these data security is a very, very important aspect of it, which can be very onerous on all of us. It's very, very risky, very dangerous also. So the last but not least, all of us are responsible to make the digitization successful and ensure that the entire business transactions are covered and you are able to get the benefit of the digitization in a fruitful manner. Without that, it is very, very risky for running a business at present. Because most of the business are global business at present. As we were saying, 40 countries we are present. It can be different regulations also, which I have seen in US itself. We are there in 32 states. The regulation in each states can be different. And it's very onerous for us. So unless you drive the digitization to ensure business process is captured, please don't think business process is not only finance, it is all inclusive. Think end-to-end business, right from the day of starting of the business to end of the business. Please think on as a digitization process. Think digital first. Please don't think manual process at all. Don't think. You have to start with the digital thoughts, and that will help you to achieve the results. This I'll take for any questions. Thank you. Thank you all.
Thank you, sir. Very, very practical viewpoints there and a lot of case studies as well. Been very enlightening session. We'll take one question due to paucity of time. This has come from Mr. Sriram, who's somewhere available here in the hall. And do you think 5 to 10 years down the line, Indian manufacturing companies too can centralize finance and accounts at a centralized level without anyone at factories? Can be centralized without anyone at the factories. Can it be done at the corporate office level? So this is a mic.
Actually, we can do this. No, this is very much possible for us. There is a perception that everywhere where the manufacturing unit is there should be a finance person. Need not be there at all. For example, we operate in 18 countries. I don't have any finance person in any way. Except for US, I don't have anywhere. Everything is in Bangalore. Nobody else in anywhere else. All can be done. Remotely can be done, definitely can be done. But we need that kind of a process whereby you are able to address the business requirements of the remote location in some way. Can you not visit the place at all? Can you stay away in corporate office? Can you address all the requirements? You can, but you have to. It is an extra effort from your side to ensure the remote people don't feel that they are left out in the business. If you don't address the business requirement, then there will be a challenge for it. Even if it is a smaller job or smaller place or smaller factory or smaller entity there, you have to ensure that some amount of connectivity or some amount of meeting the business requirements are taken care in that. If it is not there, it will become very tough for us to run the business later. So now with many connectivity tools available like Teams and other things are available, you can connect with people regularly and take care of the requirement. But you need to have a methodology that it is being addressed quickly. That is core.
Thank you, sir. So on that note, we come to the end of this session. May I now request Group Captain Vijay and Mr. T.G. Suresh to come and present a memento. Okay, Mr. Jagannath. So, ladies and gentlemen, he's come all the way from Bangalore to deliver this 45-minute session.
I'm extremely happy that I am crossed 50 now, because after listening to Jagan, I don't have to worry about it. அவர் சும்மா கிளாஸ்லாம் நாங்கள் நார்மலாக சொல்லும்போது ஒரு படத்தை பற்றி ஒரு சும்மா ஏதாவது அவர் ஸ்டார்ட் பண்ணுவோம் ஆக்சுவலாக. இவர் சொல்லும்போது பார்த்தா ஒரு விவேட டிபேட். விசில்னு ஒரு படத்தில் வந்து விவேக் வந்து மனசில் இருக்கலாம் பேசுவோம். அப்போ ஒரு ஸ்டூடெண்ட்டை ஆர்கியூ பண்ணேன், ஏன் ஸ்டூப்பிட அவங்க தமிழ் படம் எடுக்கிறீங்கன்ட்டு. இவர் என்ன சொன்னார் பாருங்க, ஏதோ அமேசான் இவர் போறாராம், இவர் பொண்டாட்டிக்கு வந்து லிப்ஸ்டிக் வாங்கி கொடுக்குறாங்க. என்ன So now we criticize that it's become a reality, but anyhow, it was a bit scary also. Thank you very much.
So moving on, we go to special session 6 now, and the theme of the session is again very interesting: evolving business, financial models, and its interplay with tax landscape. And to deliver the session, we have Mr. Pradeep Narayanan, partner, Pricewaterhouse and Company LLP. So may I have the AB of Mr. Pradeep Narayanan, please.
Mr. Pradeep Narayanan is a partner at Pricewaterhouse and Company, LLP, with over 21 years of experience in tax and regulatory advisory. Mr. Pradeep specializes in international tax, M&A, entry and exit strategies, and complex tax issues. He has worked with EY and KPMG, where he led key initiatives in corporate tax and cross-border tax planning.
Thank you. May I now invite Mr. Pradeep to deliver his address, please.
Yeah, you got it. No, that's okay. I can continue. It's fine. Yeah, so good afternoon, everyone. Thanks to MMA for giving me an opportunity to present a session on evolving business and financial models and the tax interplay. Like many of us, I was also a student of T.G. Suresh, way back 20 years back, and I would most definitely say that he was one of the person who actually motivated me to take up tax, and it's an absolute honor to make this presentation in front of him. Unfortunately, my colleague Madan couldn't make it. He had an exigency, so bear with that. Before we actually get into, what I want to cover, which is basically around business and financial models, given several trends that have emanated post-COVID era, what I wanted to touch upon was a quote that I came across, and most of you would have read this quote. of Benjamin Franklin, right? What he basically said was there are only two things which are certain in life, which is death and taxes. But the interesting twist to that was brought in by one Mr. Will Rogers. What he said was the only difference between death and taxes is that death cannot get any worse. Which I thought was very interesting because, you know, the way the tax authorities are acting all across the world is to try to clamp on to situations or transactions and enhance the tax base. And that's what we've seen increasingly across geographies, not only India, but across geographies. In fact, you know, there was a very recent survey that came in terms of which is the most aggressive tax jurisdiction in the world. And any guesses around that? It was not India. Any guesses around which is the most aggressive tax jurisdiction in the world? It was Australia. Right, so Australia was the tax authorities there, you know, are trying to enhance the base in terms of taxation. They've come up with very, very drastic and regressive measures. And again, you know, the objective of this session is to at least sensitize you around some interesting business models we are seeing. And if you come across that in your situations, in your company situations or client situations, then it's important to at least understand how the tax dynamics sort of work. So before we jump onto the models, I think one important thing that I wanted to spend some time on is around the mega trends. So PwC actually came up with a publication a couple of months back in terms of what are the key trends that is happening across the globe and why the dynamics from a business and a financial modeling standpoint is changing, right? So the first thing is climate change. We all know that governments across the world, you know, are having a significant emphasis in terms of decarbonization. They are incentivizing companies to undertake decarbonization measures. You have CBAM taxes coming in continents like Europe, which is going to completely change the way the world is going to operate. India is also committed to a net zero commitment by 2017. So I think climate change as a theme or a mega trend is going to have a very, very important bearing in the way companies tend to conduct business. The second thing is around technology disruption. I think the previous speaker did speak about that, which is to say that you have several elements of technology disruption coming in, right from artificial intelligence, robotics, blockchain. You know, you have something called as hierarchy biology. I don't even know what it means, but you are seeing significant trends from a technological advancement standpoint, where companies are effectively reaching out to customers despite not having a physical presence, right? And tax again is going to have a very significant play as technological disruptions happen across the globe. The third thing that we see is a fracturing world, right? And this started after the advent of COVID. At least prior to that, a lot of things were very globalized. You know, there was very easy access to markets, to countries, to customers, etc. But after COVID, there has been a pent-up, feeling of nationalism, where every country wants to create a self-reliant economy rather than looking at efficiencies that has been built across the globe. And this kind of nationalism, maybe it's a good thing in one way, but largely for an interconnected or global kind of a world, it's not a great thing. But a fracturing world and the policies thereon could also have a bearing in which by which, you know, companies sort of land up conducting businesses, right? The next one is around demographic shifts, right? So what we have also seen, and I'm sure you guys have read articles in the recent past to say that, you know, a lot of economies are aging, right? And we've seen this with Japan, we've seen this with Korea, but very interestingly, what I also found out was that European countries like Italy or Spain will actually have an aging population of 75 plus in terms of median age by 2050. I mean, nobody could have fathomed this, but it is not only happening in the Asian economies, it's also happening in the European economies. And therefore, the whole demographic shift is a big mega trend in terms of availability of skilled labor, so on and so forth, which companies will start focusing on. So what all these things have led to is social instability, right? I mean, the last 2-3 years, inflation has gone over the roof. What was costing a pound in London 3 years back is costing about £3 in terms of a liter of diesel. So I think, these kind of social instability is leading to a chaotic kind of world. And that is where, corporates are coming up with fairly innovative business models to reach out to their customers. So let's look at some of these models. I've got about 5-6 of them, and I'm hoping that we'll have time to sort of cover that. One model that we are increasingly seeing is companies being very, very light in terms of assets on their books, right? So historically, the whole thought process was the more assets I had in my books, the more valuable the company is. You had a bunch of players like like Reliances and Tatas of the world, which were sort of heavily investing on industrial equipment, heavy machinery, etc. But the trend that we have seen in the last few years is that a lot of corporates are moving away from highly intensive kind of assets, and they want to be asset light, right? So being asset light coupled with subscription as a service is something that we are increasingly seeing. Okay. So how does this model work, right? So let's say you have a manufacturer. The manufacturer will construct the capital equipment. And maybe we can probably take hospital as an example, where the end customer is the hospital, right? So this capital equipment, be it an MRI machine or whatever that is, costing a couple of $1 million, earlier was imported or purchased by the hospital, and that used to be an asset in the books. But now what we're seeing in terms of a model is that the manufacturer is actually offloading that to a finance company. So the finance company takes it on its books and then gives it as a lease to the hospital. So effectively, the only cost for the hospital is the lease rentals that it pays to the finance company. And any kind of upgradation to the machine comes through a subscription model, right? Where either the manufacturer or another service provider, which is an outsourced vendor, will effectively work on the upgrades and have that provided as a subscription to the end customer. So net, all the players in the chain are fairly happy with this kind of a revised model. The manufacturer, because he's able to sell products, he's not having an inventory clog that's happening. A finance company, because they know how to manage the whole finance leases, the interest thereon, etc. The end customer, because one of the biggest advantages for the end customer is with the technological advancements, he is able to quickly replace these assets depending upon the maturity of the technological advancement. And you have an ancillary service provider who is always going to be filling you with sort of updates, right? So this we're seeing as a fairly emerging kind of model, both in the auto industry, where commercial vehicles are being sold to end customers, or in the healthcare sector, where highly capital intensive equipments are sold, right? Now, what are the tax issues that will effectively come in, right? So one tax issue is basically in terms of the whole depreciation. Who's going to claim the depreciation? The finance, the NBFC typically will be the owner of the asset as such, but it will not have effectively the income for an offset. So how do they go about, claiming the depreciation is an issue that we've seen in this kind of a model. There could be a lot of cross-border issues. So for example, if the subscription provider is actually not based in India, is based overseas, whether there is a withholding that needs to be done on the payouts, which is being made by the end customer to the subscriber or the subscribing service provider, that could be another issue that comes in. Again, the third issue is, if it's only going to be a lease that is getting provided to the end customer, how will the whole GST mechanism work around that? Will it actually be dependent on the GST leviable on the underlying product? Because there are some circulars to say that even with respect to lease, it needs to go back to the underlying product. So for example, if the lease is on a automobile, will a 28% plus GST be applicable? So these are issues that we need to sort of grapple with. And more importantly, you don't want any kind of a vicarious liability created on the end customer, right? Where he is liable for an act of any of the other service providers. So that is a model that we are seeing. Again, a lot of the issues thereon are still evolving, but this is something which one would need to sort of effectively bear in mind. The second model that we are seeing is basically a rejig of the trading model, right? So in a typical kind of a scenario, what would have happened is that an Indian entity sort of manufactures products, it exports to a overseas customer, right? From a FEMA standpoint, you need to ensure that your export proceeds are realized within a period of 9 months. But what we've seen in the recent past, especially with the whole Middle East crisis, economic crisis in Sri Lanka, Bangladesh, etc., the customers are not paying within the 9-month period, right? And the moment you have a situation where this is not getting paid within the 9-month period, you have non-compliance from a FEMA perspective. And to overcome this, we've seen clients look at setting up a distribution company overseas, right? So effectively what happens is that the Indian entity, which is manufacturing the goods, will sell it to their own distribution network or a distribution entity overseas. And the distribution entity will in turn sell it to the end customer. Now, the advantage with this is, the leg relating to the Indian entity and the foreign intermediary, that leg, the export proceeds would need to be realized within a period of 9 months. There is no time limit in terms of the realization of export proceeds between the foreign customer and the foreign intermediary, which is effectively my own subsidiary. So there's no time limit, and effectively you're able to ensure that the FEMA-related restriction is duly addressed. But the challenge with this as such is, obviously you need to have enough working capital, because, if there is a time lag in terms of the foreign intermediary paying the Indian company and realizing from the end customer, if there is a time lag, then obviously that working capital related cost will need to be effectively dealt with. But what we are increasingly seeing is this is used as a strategy for companies to win new customers, enter new markets, so on and so forth. And jurisdictions such as Singapore is actually favorable in terms of funding the foreign intermediary, etc. And even from a tax standpoint, it is resulted in fairly good kind of tax rates. The other issues that might arise with respect to this model is, firstly, from a place of effective management standpoint, because under the Indian domestic tax laws, if an Indian company has got a foreign subsidiary to which it's effectively selling, then it needs to ensure that the effective management of the overseas entity is not in India. Otherwise, the entire income will get clawed back into India. So you need to put some guardrails to ensure that a POEM for the overseas entity in India does not get triggered. Similarly, you need to have economic substance in the overseas jurisdiction, because countries like Singapore actually offer a lower rate of tax of 5 or 10% if economic substance is actually present in terms of employees, in terms of assets, expenses, etc. So you'll need to ensure that in order to claim the lower rate of tax. Transfer pricing becomes important because you are trading with your overseas subsidiary. So you need to ensure that from a transfer pricing perspective, the transaction price between the Indian entity and the overseas subsidiary is at arm's length. And one one element that also needs to be factored is that the margins need not be on the actual purchase. It can be on the value addition. So depending upon the functions that the overseas entity is doing in that geography, the margins can be effectively on that basis as against the broader spectrum of the purchase, right? And again, what we also understand is several jurisdictions are fairly competitive in terms of interest rates, right? And therefore financing is a driver for companies to look at this particular model, right? Because in India, the rates of interest can hover anywhere between 10 and 13%. But in the overseas geographies, it's probably around 5-6%. And again, you'll just need to factor the hedging element of, with respect to it. But it's still far more competitive. And that's also another driver for companies to effectively look at this model. The third one is, it's in the inbound context where, we've seen situations where Indian clients, right, or Indian customers or foreign suppliers want goods just in time, right? They don't want a situation where goods are shipped from the foreign jurisdiction to India, and that takes, X or Y months with whatever is happening in the Red Sea, etc. The timelines around this also may get significantly elongated. So a lot of Indian customers would want a JIT or a just-in-time kind of a delivery, and the use of free trade warehousing zones is also something that we are increasingly seeing foreign suppliers use. So the way the model works is, the foreign supplier will have a unit in an FTWZ. The goods will be shipped to the FTWZ, and when the goods are shipped to the FTWZ and imported into India, there is no customs duty kind of liability because, like the name suggests, it's a free trade warehousing zone. And then, the goods are cleared on a just-in-time basis to the Indian customer. And that's where the trigger from a customs duty or a GST standpoint happens. So again, this is a good model to ensure that goods are available to the Indian customer on a timely basis without payment of duties. The only aspect that we need to sort of consider here for the foreign supplier is whether stocking the goods in the warehouse is going to create a permanent establishment or not. Because, if they are going to do activities other than merely stocking, then depending on the treaty, it could have an exposure for the foreign entity in India. But otherwise, this is a fairly common model that we are seeing from a transfer pricing or from an indirect tax and customs perspective. This should be a model which will fly. So I think, the previous speaker also touched upon the role of global capability centers. So what we are increasingly seeing is that with respect to multinationals, their Indian subsidiaries are being used as a bed to perform a number of functions, right? Number of support kind of functions, be it on the finance side, be it on the process side, etc. What we have also seen is that today, after COVID, the reporting lines are completely blurred. So historically, what used to happen was employees of the Indian subsidiary used to have a dotted line and a hard line reporting to the Indian management. And therefore, they were working effectively as employees of the Indian company. But now, with COVID kicking in and the reporting lines getting blurred, there is more a horizontal way of working where a bunch of employees work on global projects and not necessarily projects which India caters to or the Indian entity caters to. Now, this has resulted in significant risks for the foreign company in India, and the tax authorities are vehemently looking at the whole concept of whether this situation creates what we call as a virtual P for the overseas entity in India. The general thought process is, if there are any support functions rendered by these employees, then it should largely be okay. However, if they are involved in executing core functions for the foreign company in India, then it's a high risk kind of a scenario. And there have been a few rulings which have sort of looked into it. Very recently, there is a Delhi High Court ruling in the case of Progress Rail, where this matter was dealt with and it was given in favor of the taxpayer. But the fact that the tax authorities are looking at these kind of issues, you will need to sort of factor as you evolve your business models on a go-forward basis. A similar issue would also arise where the foreign company, instead of having an Indian subsidiary, it is going to sort of use independent contractors to execute work. There also a similar risk would be there. And if these individuals are all part of an entity, so we have several players in India, right, which actually do this manpower supply. There's a player called ANSR, etc., which does the initial setup for the foreign entities' presence in India, and then they do a bot. So even there, this risk is fairly exaggerated, and one would need to be careful, especially if you're entering into contracts with independent contractors, etc. Right. So again, e-commerce as an area has evolved. There are different models which are evolving in the whole marketplace concept. But the traditional e-commerce kind of a model where, the marketplace, be it the Amazons or the Flipkarts of the world, only, provide a mechanism for the buyer and seller to come together, that should be okay. But the moment the marketplace starts assuming title to the goods, that's where the issues from a tax standpoint will get extremely complex. So one issue that could potentially arise is, let's say I'm doing a withholding, right? I'm actually buying goods on Amazon. Let's say for whatever reason, the title to the goods is with Amazon. They buy it from the retailer, they sell it to me, and there is a consolidated kind of an invoice. The question is, if there is withholding tax obligations cast on me, would that be on the entire consideration, or would it be only on the fee payable to Amazon? So there again, if it's a contract where the title effectively has been taken over by Amazon, then you will have a risk of the withholding coming in on the entire amount and not only the fee. But if the title to the goods has not been passed on and Amazon sort of continues to operate like a marketplace, then it should effectively be on the fee. But again, we are seeing variants to this model. Zepto has come up with this whole dark warehouse kind of a concept. You have actually players who are acting as subcontractors for the marketplace. So the variance will need to be sort of looked at. Clearly from a income tax as well as from a GST standpoint, we believe that this is a big area of concern, which the government or the tax authorities are going to sort of effectively going to latch on to in terms of extracting more sources of tax revenue. So, for example, what we understand from a GST standpoint is that two players, right, cab aggregators, one Uber and one Namayatri, the Karnataka AR has given different views on very similar fact pattern, right? So even an element which can be differentiated, the tax authorities are trying to differentiate that and levy the higher rate of tax. So we've got to be extremely careful as we deal with models such as this. Yeah. So I'm conscious of time. I think the last thing that I would want to cover would be the whole Gen AI bit. So this again, we are seeing it emanate in mature geographies. So effectively what happens is you have a foundation model, which is your basic AI, and that foundation model is being developed further or customized by the developer, right? So it could probably be a Samsung, which might probably take the Android, which is getting developed, and then get into further customization. And that is then given as a subscription to the end user, right? So the question really is when the end user makes a payment to the developer, what is the withholding tax position, or is there a GST on this, etc. GST would be applicable because, it's a reverse charge kind of a service, but withholding tax, one can effectively take a view that it should not be applicable because this is again, a shrink wrap kind of a software or a shrink wrap service which is getting provided to customer, and it is not customized at the behest of the customer, right? So that's the element which needs to be sort of considered. But again, this is a model that will probably evolve over a period in time, and the tax authorities may come up with differential views on this. So that's all I had to cover. I mean, effectively in terms of the business and the financial model, the thought I wanted to leave with the audience here is that it's very, very dynamic. I don't think there's one shoe that fits everybody. And therefore, as you start talking to your vendors, suppliers, or customers with respect to transactions, just be cognizant that, tax is a very, very important element that needs to be weaved in as part of your commercial negotiations. Otherwise, like I said, the kind of liability that will get fastened on you would be enormous. So thanks again to MMA for giving me this opportunity, and I'm happy to take questions.
Thank you so much, Mr. Pradeep. There are a few questions maybe you would like to.
Okay. Right. So there's a question from Pranav which says, how can CFOs ensure that evolving business and financial models remain compliant with dynamic tax regulations while optimizing tax efficiency? Right. So I think, a lot of people whom I talk to, right, they all feel that with the advent of general anti-avoidance rules that's coming in, not only in India, but across the world, any tax planning is something which is frowned upon by the tax authorities, right? And again, my submission to them is there's a difference between tax planning and tax avoidance, right? So tax planning is something which you're doing within the contours of law, which has got probably a commercial rationale where tax is only an incidental kind of a benefit that you leverage on, etc. So I think, in my view, again, tax planning is legitimate and that should not be frowned upon by the authorities, right? And therefore, if there is an ability to get into a tax efficient kind of a position, you should always look at it. So let me give you an example, right? One of the things that we always advise clients when they go for tendering in, let's say, EPC contracts, is how do you structure some of the terms of the contracts so that, it's not viewed as artificially splitting, right? But you can still derive the tax efficiency. So for example, in an EPC contract, there's always an offshore element. There is an onshore element. If you have a composite contract, everything for the foreign supplier will get taxed in India. Generally, the tax is put on the Indian customer, so your tax outgo would be significant. But if there is an ability to split this, right, and again, subject to all your anti-fragmentation rules, etc. But if there's an ability to split it, I think you should probably look at it. So, if there is an ability to look at tax efficiency, you should look at it. Clearly, it should not fall within the realms of a tax avoidance kind of a scenario. But I don't think looking at tax efficiency is a sin. Okay. The second question is, what proactive measures can CFO take to adapt their financial strategy to interplay digital business models and emerging global tax trends such as BEPS 2.0, etc. Okay. So I think, let me just spend a couple of minutes in terms of explaining what is BEPS 2.0, right? So BEPS 2.0 has got two parts to it. One is, ensuring that there is a global minimum tax rate in various geographies which enterprises operate on, subject to a threshold. It's a $800 million or $750 million euro kind of a threshold. But the point is, there is significant thrust on substance, right? So I think, my submission to any CFO who wants to operate across economies or across the globe is, first of all, see whether you will be able to create that substance, right? And then if you're able to pad on to that particular substance, then your ability to claim all your benefits would be far higher, right? So like I said, if you want to have a distribution set up in Singapore, if you're able to have people functions housed there, then there should be no denial of the benefits under the domestic laws of Singapore or the treaty that Singapore has got with different countries, etc. So I think the crux to ensuring that you are tax compliant would be substance and economic substance, right? So that's an element that you should sort of focus on. The third question is, what role can CFOs play in aligning tax planning with broader organizational goals of governance, sustainability, and value creation in the context of evolving financial models? See, I think, this is also a mindset of the company, right? So, for example, you take players like Tata's, etc. They would have a particular mindset in terms of taking aggressive tax position because of reputation risk, so on and so forth, right? But if the mindset is, I want to do something, and if it's within the contours of the law, you want to plan for that. Like I said, at the beginning, there's nothing that's going to stop you, right? But as you sort of start executing the planning options, etc., look at elements such as substance, what is the economic rationale of doing a particular transaction, etc. It should not just be for taxes or saving up on taxes. I think the economics should drive the conduct, and the conduct should be the driving factor in terms of your conclusion on the tax position, right? And the last question is, what are the key tax risks and opportunities CFO should consider when integrating sustainability initiatives into their business opportunities? See, I think more than tax, I would probably say, there is this whole element of reputation, right, which is very important. So today, if you see, sustainability is up in any CFO's agenda, right? So the way I, manufacture goods, do I manufacture it out of renewable sources? The countries I import it from, what is the level of their carbon footprint? Europe, after it comes up with the CBAM measures, when you're exporting into that particular country, and if it's got a heavy carbon footprint, the taxes can be, probably 40-50% of the price of the good, right? So I think, these are elements that you will effectively need to weave in. Like I said, tax is only going to be, incidental to the entire process. From your perspective, you will need to figure out where you rank in terms of your sustainability quotient, etc. So, for example, I was told by someone who does a lot of work on sustainability that, if your ESG compliance is high, right? If the ESG compliance quotient is high, then it could have a bearing on your listing price. So these are all, very intrinsic factors which is not going to effectively surface in some literature. It's basically the conduct and the way you go about carrying your business. Yeah. All right. Thank you.
So thank you, Mr. Pradeep. A very, very nice presentation first, and thereafter a very, very lucid, the way he answered the questions and each of them. Thank you so much. May now invite Group Captain Vijay Kumar and Mr. Suresh to present a memento to Mr. Pradeep Narayan for taking the time off and being here today. Of course, we did miss Mr. Madan being here today, but I think you covered it up for his absence as well. Thank you so much. So thank you so much, and we are now coming to the last session, special session. As I say this, I can see a lot of smiles on the face, and we're starting is 10 minutes ahead of time. So that's the good news. So we are getting into the last session, which is on sustainability reporting and ESG compliance. I think this kind of sums up the entire conclave today. And to have this session, to deliver this session, we have Mr. Arun Rajagopalan. May I request you to come and please take place on the dais. So Mr. Arun is partner, Price Waterhouse Chartered Accountants LLP, and may I have his AV, please.
Mr. Arun Rajagopalan is a partner at Price Waterhouse Chartered Accountants LLP with over 20 years of experience in audit and assurance. Specializing in auditing large multinational companies, he provides expertise in financial reporting under Indian and international GAAP. Mr. Arun also leads PwC Chennai's ESG reporting initiative and advises clients on accounting challenges, internal controls, and IFRS compliance.
May I invite Mr. Arun to make his presentation, please.
Good evening, all. I'd like to, at the outset, thank MMA for this opportunity. I'm acutely conscious that I'm standing, between you and a good Saturday evening. Thanks to Pradeep, I think we've got 10 minutes. I think he's given back 10 minutes to you. So I'll try to kind of be consistent with that theme so that, we probably let you go earlier than later. So I think sustainability reporting and ESG compliance, I think it's pretty much a very relevant topic in this day and age. It's the buzzword, so to speak. All the acronyms that come along with an ESG reporting are something that people have been studiously reading, and likewise is the case with me as well. So I kind of try to give an outline in terms of what's the reporting remit in India and in the rest of the world as well. Because I'm sure a lot of you would be also part of large groups which have obligations to report across the world. And in that regard, I think an awareness in terms of what is expected from a company in India in terms of reporting by companies outside of India is also pertinent. Briefly, I think what we'll try to aim to cover is obviously why ESG. I mean, what's the need? I mean, is it an old wine in a new bottle, or it's probably the new fad that's actually caught on everyone's imagination? The reporting landscape at large, globally, and then also in India, and then there is also an assurance angle to it. I mean, anything that comes through in terms of reporting, I think assurance follows through immediately, purely to kind of give a lot of credibility to the numbers that have been reported. And there are also aspects relating to value chain. I mean, BRSR, we will talk about it a bit, but there is also just not the reporting in itself in terms of the company's operations, but also in terms of their own upstream and downstream, ecosystem in terms of their supply chain as well as their distribution network. What is expected in terms of, operations with them, and what are the ESG matrices that companies need to report in terms of, statutory requirements. I think those are some of the things that we will touch upon. In terms of the business imperative, I think Pradeep also alluded to the fact that in terms of ESG being one of the key metrics which companies do look at in terms of when they go public. That's probably one narrative that companies do want to kind of call out in terms of their own sustainability initiatives. And I think it is also emanated from the fact that ESG, if you were to look at it, E was one of the key attribute which was there for a period of time. environment has been a continued, focus over a period of time across the globe, across countries and across companies as well. But I think the S&G, the social and governance aspect, is also caught on in a way. Obviously, environment, it is very important. I mean, all of us are privy to, disruptions in environment in terms of how whether climatic changes have been impacting, the overall ecosystem in itself. So that has been a focus area. Governments have been very focused in terms of looking at it, trying to build some consensus in terms of use of conventional source of energy, fossil fuel, and how do you kind of replenish and move on to renewable source of energy? How do you kind of keep climate changes at check? But the social and governance aspects have also kicked in, I think. And it's again, I would say, companies they've been good corporate citizens, doing things on their own, but there's been a little more method to madness as you look at it in the context of how it is shaped up over a period of time. And this has really caught on very rapidly in the last few years as well. I mean, if you see a lot of, capital markets have been very conscious of it. Private equity investors have been very conscious of it. Companies which actually seek funds are being evaluated on sustainability metrics consistently. And then regulators, of course. Obviously, if there is a governmental consensus cutting across geography, then it percolates down to regulators, because then there is an implementation need in terms of how do you go about actually implementing some of these indicators and behaviors. And so, to the extent access to capital is one of the prerequisite today. Companies have been doing, apart from financial due diligence, legal due diligence, and tax due diligence. There is also quotient that is built up in terms of ESG due diligence. I mean, companies are looking at ESG matrices to say, before they invest, whether these are actually being also looked at in the right way. There have been many instances where, in the recent past, IPOs have not been successful. I mean, the narrative in terms of social, I mean, if you look into it, in one of the companies, Deliveroo in UK, actually had a very bad IPO. I mean, they had to pull out because they were in the gig workforce place, aggregator space, and then I think there were some issues in terms of what's being paid out in terms of minimum wages and whether that's been pretty commensurate with the nature of work that they do. So their IPO tanked and they had to pull back. I mean, there have been many cases like this where actually some of these vibrancies have caused a serious impact in terms of how companies have planned their business models. Obviously, talent attraction and retention of people, I think there is also another area where a lot of, the next generation has been looking at very closely in terms of ESG metrics of companies. Are they sustainable? Are they looking at it in that context from an overall awareness standpoint? I mean, reputation obviously is a very important aspect. Companies are moving to, call out what activities they've been doing in terms of ESG when it comes to more so to build their reputation as well. And now, obviously, there is a lot of focus. If you look into auto sector, for example, auto sector is extremely focused in terms of just the OEMs percolating it downward to their tier 1 and tier 2 suppliers in terms of calling out very clearly what are the initiatives that they do undertake in terms of environment and social and governance as well. Obviously, there's also companies have come to believe that there's a clear brand differentiator. We would actually, there are empirical data to demonstrate that, there is a clear differentiation that companies bring onto the table, especially in the capital markets. You have an Nifty index in terms of ESG index, and then if you compare that with the other indices, you would certainly see a step up in terms of the, the percentage in terms of what you would expect from an, Nifty ESG index vis-a-vis the others. So some of these are very clear value differentiations that are, that are actually making a lot of companies be more conscious towards sustainability. And obviously, all of this can be, unless until it's reported, you would not necessarily get into understanding the, how it's actually culminated, right? I mean, companies may take initiatives. Companies would go about doing a lot of these stuff, from an overall, their own perspective. But unless until it is reported in the right manner, I don't think it kind of gets, cascaded across to various sets of stakeholders. Unlike a financial statement, which is pretty much a very, I would say the narrow, I wouldn't say narrow, but very clear focus has been over a period of time only shareholders, right? I mean, if you were to actually get a accounts, financial statements audited, the primary user of the financial statements has been shareholders. But if you see in ESG, it is pretty much there are a multitude of stakeholders. There are regulators, there are government authorities, there are employees, unions, customers, as it says in the right-hand side. There are a host of people who are actually interested in terms of ESG metrics when they are reported by companies. And so this is one of the key reasons why companies have been really focusing today on ESG initiatives. It could be one reason or other. I mean, you may be listed, so you would see, most of the analyst calls, investor calls, you would have questions around ESG. You would have investor presentations made by listed companies. You would see a couple of slides allocated for sustainability matters. So there's clear, appreciation of the requirement, and then hence the information, I wouldn't say overflow, but at least the cascading of information in this regard. And then if you look into it, I mean, as I said, all of this has to culminate into reporting, right, at the end of the day. And the reporting is governed by different, I would say frameworks, regulators across the globe. It is it's a moving target today. I mean, there is a confluence of standard setters, different regulators who've been actually, working through in terms of different jurisdictions, in terms of the reporting that is required. But that said, there has also been a clear consolidation of various standard setters and regulators as well. If you were to look at it from a global standpoint, truly, while the critical ones in terms of companies which have been already reporting on sustainability initiatives, I mean, they do issue a sustainability report or an integrated report, as you would know. A lot of companies have been doing, even in Indian context, all of these in the past. And so the equivalent of an accounting standards that we're all used to, in terms of non-financial indicators like the sustainability indicators, has been a standard called GRI, Global Reporting Initiative. A lot of companies would actually baseline their report purely based on GRI indicators. So GRI was pretty much an widely used standard for a period of time until a lot of other reporting frameworks came into play. One of them critical being, especially from a European context, is CSRD. CSRD is Corporate Sustainability Reporting Directive. So the European Union came up with a requirement for companies from 2024 onwards, which is the December 2024 onwards, which is this year, to report on CSRD matrices. I mean, there are various matrices that have been called out by them, roughly around 1,000 odd data points that have to be given, disclosed, and then it is pretty much, there is a glide path in terms of which are the companies which can do at what point in time, and gets kind of phased out from a reporting standpoint. So CSRD is one, and then they are pretty much baselined, having regard to standards called ESRS, which is European Sustainability Reporting Standards. So while companies were actually working on GRI in Europe, now we have to migrate to ESRS. So there is an interoperability of standards. Standard setters have been sitting together to figure out what is the delta. I mean, if I've already been reporting on GRI, if I have to move into an ESRS standards, then what's the incremental that I need to, as a company, capture? So that's one body of work that's happening. And then that said, when ESRS is a standard of reporting, International Sustainability Standards Board, ISSB, which is part of IFRS Foundation, came up with their own standards, S1 and S2. While, of course, these again don't have, unlike ESRS, which has got legal EU requirement to, for companies to report, ISSB standards are more governed by country-to-country implementation. So as countries have started making it mandatory, there are various countries like, let's say Singapore, Canada, a lot of them have been, kind of bringing it into their own regulations to say companies which are going to report under on sustainability matters can use S1 and S2 standards in this regard. There again, ISSB had a bit of a consolidation of various reporting entities, which is typically the integrated reporting. There was also TCFD, which is a task force for financial, climate-related financial directive disclosures. So it typically calls about, it's pretty much a founding, requirement in terms of assessing climate risk, reporting on climate risk. A lot of companies which were actually, discussing on climate risk and reporting on climate risk used to use TCFD as a basis for that. So there was a fair bit of consolidation at an ISSB level itself. So now if you were to see, and then of course from a US standpoint, US being US, you had your SEC come up with a set of rules as well. Those rules have been pretty much now, challenged in the court of law. So that's kind of still kind of getting resolved. But they did come up with their own set of requirements in terms of climate-related disclosures. I mean, for listed companies, they had to kind of they called out what kind of disclosures have to come through in terms of their own financial footnotes and other than financial information. So if you were to look at it from a global standpoint, typically Europe has taken lead. So there is a CSRD which pretty much is the the governing reporting requirement for a lot of companies in Europe. And that's of course in a phased manner. So, if you are part of, let's say, one of, companies here are part of an European conglomerate, if they have to report, and they will actually typically have to report on a consolidated basis, which means they would need information in respect of those data points pretty much for operations in India as well. So that's again an area where companies are looking at to see is there a readiness in terms of what information ought to be sent back to the parent company, and how does that get kind of processed from an integrity standpoint, and how clear are we in terms of applying those standards. So that's one area which really caught on the imagination of various sets of people. The other one is obviously the SEC, which I think is on hold at this point in time. ISSP, if people want to do it, they could do it voluntarily. So at a very global level, these are some of the reporting frameworks and the underlying standards which govern the reporting requirements of companies. But moving pretty much, I mean, just a further brief on CSRD. As I said, CSRD kicks in from 2024 onwards. But if you see here, effectively, 2024 is more for listed companies in Europe. There are certain criteria. If there are public interest entities, entities with more than 500 employees, a large group, then it kicks in for them, and then they will have to report this from, let's say if it's December 24, before June 2025, they will have to report it and then file this, with the regulator there. But there are also other thresholds which will come for other large undertakings or large groups, which is typically to say that if you have a turnover of more than 50 million euro, balance sheet size of 25 million euro, and 250 employees or more as on the closing date for the last two out of three years, consecutive years, then it kicks in as well in terms of those companies. And so if it kicks in for them, then it percolates downstream to all their subsidiaries, because it is a consolidated report that companies have to issue. It's not, they don't have a choice to say they will only report on the European entity. And so likewise, it moves to 2026. And then if there are non-EU reporting entities, let's say, I'm just making for example, let's say there's a Dr. Reddy's or a Wipro or an Infosys, which has operations, which is a global conglomerate sitting out of non-EU based global groups, but it has operations in Europe. And then they would have to do a consolidated reporting for their entire operations, just not the European operations. And then that kind of gets staged from 2028 onwards. But there are still standards which need to be kind of put out for them. There are, the regulators have been working through to say non-EU reporting groups, then what are the standards? Are there any concessions that can be given? But that's in due course. And all of this data will actually get assured. There is a limited assurance over a period of time, which moves to a reasonable assurance thereafter. So there's a glide path around that as well. So this again gets audited, and then the reports are out as in the public domain as well. So this is on CSRD, and this is actually really caught on the imagination of many people. Even companies in India are looking at it more closely, be it if they have outbound entities which are placed out of Europe, or if they are part of an inbound in terms of companies having parent out in Europe and then having operations in India. And briefly on the IFRS standards in itself, if you look into it, I mean, there are two standards, as I said. The standard S1 is more to do with, the overall, I think it's again based on, a lot of this is based on the TCFD, because TCFD, talked about the 4 pillars, which is strategy, metrics, governance, and risk management. So every company, and this largely gets covered in your S1 disclosures as well, and in S2. S2 is more in terms of, the greenhouse gas emissions, the disclosures relating to those. But general, S1 is more in terms of general, which is, if you were to draw a parallel, it could be the accounting standard 1 in terms of relevance, the comparability, all of those that you would have as the founding principles of preparation of financial statements. S1 looks into it in terms of all of those. So strategy, vision, controls in place, process in place. So all of those are the ones that companies have to disclose. So what you would note in some of these reporting requirements is just not purely quantitative information. It's also qualitative information, because it actually expects the reporter to talk through in terms of what are the initiatives, what are the mechanisms in place. And so a lot of them could be qualitative as well in terms of the governance model, governance structures in place, what are their initiatives. So all of those are there. And so these standards typically cover pretty much the whole edifice of reporting in terms of the general disclosures or disclosures pertaining to the GHG emissions as well. But that said, there is also more industry specific. Of course, when you do all of this, companies pretty much have to look into something called as a sustainability related risks and opportunities. They call it as SRO. So what happens in a normal scenario when you actually do a financial statements preparation or an audit, you would look at what are the risks, financial statement risks. So companies here will have to identify sustainability related risks and opportunities to say if they were to look into typically what is critical for their business existence, what are the risks that are relevant for them from their own business standpoint, and what are the opportunities that are there for them to improve. I think that is a pretty much a calculated assessment that companies do. It's an iterative process. They go through pretty much an inside out and outside in basis, which means typically you look within your ecosystem, check with various stakeholders within your company, understand what are the priorities. You also do the same with external stakeholders, could be vendors, could be customers, could be community around you. So there is a evolved process that companies go through to identify what are the material risks and opportunities. And again, materiality is pretty much the materiality that we are used to from a financial statements audit standpoint, and so this is an assessment that companies have to do. Once the company does an assessment of this nature, then they will have to call out, look into the 4 pillars around these material topics. So if they say water, because I'm in an area where water is pretty much a scarce resource, and so that is the risk that I have for my impending operations, because a lack of water over a period of time may actually make me shift premises from a particular place to another place, which can be more viable for me. So that's pretty much a risk that can kick in. There could be opportunities on the other hand, similarly in terms of water, because companies may take some initiative to improve the water table itself. And so that opportunity could also be brought in terms of, how do they kind of strategize it? Because they will then kind of call it out to say this is what they intend to do in terms of water management, and this is how they plan to proceed with respect to making it sustainable. And so all of this material topics that are identified are then put in the prism of strategy, metrics, governance, and risk management, and then those are the ones that are disclosed pretty much. And I would say largely, if you look into it, be it regardless of the standards, some of these principles are enshrined. I mean, it may vary in form and shape, but pretty much the concepts in terms of identifying material sustainable topics, core to the company's operations, core to it could be, I'm just making another example, giving another example. If let's say an automotive company today, because of all the fossil fuel related issues and climate changes, they may perceive electric vehicle to be a risk, which means then that if companies will have to move to electric vehicle at some point in time, they would have a significant depletion in terms of their own manufacturing facility. They will have to accelerate the depreciation in terms of their ICE vehicles, or they will have to look at it from an impairment standpoint. So those could be risks as well. So there could be, these are various things that each sector wise you would actually evaluate to say from critical topics of emission, energy, water, waste. There could be various topics basis which you would actually go about checking what are the ones that are relevant to you. And likewise in terms of S and G as well. G could be code of conduct, cyber security, could be relating to privacy. It could be relating to welfare of employees, attrition. A lot of those could be the factors that you look into from a risk standpoint to say, are these critical risks for me and how do I address it from a sustainability lens standpoint? So all of this is pretty much, I would say, the baseline for different standards. It may vary in terms of how do you actually interpret them, but the fundamentals of kickstarting a process of evaluating what is sustainability from a company's standpoint will be pretty much driven by some of these core principles to say that what are the sustainable matters? What are the sustainability related risks and opportunities that I need to evaluate from a sustenance standpoint? So that's on the IFRS. But coming closer home, you would see, ESG reporting has been in different forms and shape over a period of time. You would also, a lot of us would know that even in the director's report, you would, in the past as well, we used to, still continues, companies will have to report on, let's say, technological absorption and energy conservation. What are the measures that they have taken from an energy conservation standpoint? What are the technology absorption that they have carried out over a period of time? So year on year, there has been clearly, and those are all typically you can relate it to ESG, right? Because if there's a process efficiency, you are making it a lot more viable from a sustenance lens standpoint. That's pretty much a new technology absorption or energy conservation. Moving from fossil fuels to renewable source of energy is energy conservation. So over a period of time, I think there has been a focus in terms of the regulators in India trying to build up a reporting mechanism. It's kind of now culminated into a lot more structure in terms of the BRSR itself. And then if you look into it, typically, the MCA came with national voluntary guidelines, which then got rehashed into, in 2018 into national guidelines for responsible business conduct. So that's still applicable for all private companies and public companies. It has 9 principles, which are pretty much part of your, the BRSR itself. CSR came into vogue at some point in time. It was comply or explain basis. It became mandatory after a point in time. BRR, this is business responsibility reporting, was applicable for top 500 listed companies at some point in time, and then it moved into BRSR afterwards. Because what happened was BRR was a lot more qualitative and less of quantitative information. So the regulators actually, both the Ministry of Corporate Affairs and SEBI, came up with a white paper, put their heads together, and then figured out that there was a lot of information that ought to be disclosed, which is disclosed in the international forum. And so to the extent, I think the BRR got rehashed into BRSR. BRSR is a lot more quantitative in terms of information across the various principles. And that's now coming to work for the last couple of years. Companies which are in the top 1,000 in market cap, listed companies, have to report on this. And it's industry agnostic. It's not necessarily specific to any industry. These sets of information have to be reported by all companies. And then BRSR, had an element of BRSR core which came in again last year. Out of the 140 odd questions, 40 odd questions are subject to reasonable assurance. So again, SEBI mandated reasonable assurance on some sets of core data, which is called as BRSR core, and that kicked in from last year. So top 150 companies by market cap got the BRSR core data points assured by external auditors. There is a glide path to it as we go along, we'll realize that. So there is again a reasonable assurance which kicked in, and then companies had to gear up for it in terms of looking into their own efficacy of data, process and controls in place, and the reporting set of information that was actually put out in the public domain. And just spending a moment on BRSR in itself. As I said, BRSR is made up of roughly around 145 odd questions, broken down into two parts. One is called as an essential indicators, and then another is a leadership indicator. Leadership indicator is more voluntary for companies which are, let's say, more on high on value chain, which have been doing a lot of sustainability initiatives. They probably would want to give it a shot. But a lot of companies, essential indicators is agnostic again to any industry. All companies within the top 1,000 by market cap ought to actually provide this information. And these are again broken down into 9 principles. If you look at the horizontal bar down below, you would see that it is pretty much to say there are 9 principles which talk about ethical practice and conduct of the business, sustainable sourcing of, are you part of responsible supply chain? How are you actually having sustainable goods and services being procured? How is it that you look into from an employee well-being standpoint? What is the stakeholder management? How do you get feedback from various stakeholders with whom you operate? Human rights is again a very, very focused area across the globe in terms of, forced labor, in terms of, proper working conditions, working hours. So, reporting on some of those matters. Environment again is a very critical, principle where it talks about a lot of stuff in terms of emissions that have been the companies actually having in terms of scope 1, scope 2, scope 3. It also talks about energy in terms of, renewable, non-renewable waste. It talks about what are the disclosures in respect of different types of waste that are generated and disposed of, and then water as well. Water management again becomes very important in terms of withdrawal of water, consumption of water, and discharge of water as well. So again, environment is again a key area. Public advocacy is in terms of how much the companies do in terms of advocacy, in terms of shaping up public policy. If there are any part of any associations which then drive the overall public sentiments relating to any emerging regulations, are they part of it as well? Inclusive growth again is CSR, equivalent to CSR in terms of how sustainable are they in terms of building their ecosystem, looking at the environment in which they operate and the communities at which they operate. Value to customer again in terms of feedback from customers in terms of recalls, product recalls, data privacy in terms of customer data, all of those. So there are basic tenets of 9 tenets on which you probably companies will have to report on. And these 145 odd questions is broken down into section A and B, which is pretty much I would say more generic set of questions, which gives a clear outline in terms of the company's operations, their subsidiaries, where do they operate from, what are the composition of board of directors in terms of the training policies, looking into various policies across these 9 principles. A lot of those aspects, and do they have a identified material risks, which I did mention earlier, sustainable matters. They also talk about whether do you have targets, do you have matrices, are they being monitored? So all of those are the ones that get covered in section A and B. Section C is where the meat of the information comes in terms of quantitative data, which is again broken down between essential and leadership indicators. So you have 68 essential indicators and 39 leadership indicators, which companies have to call out for. And then these are very prescriptive. I mean, it talks about Just to give an example, if you look into from social security in terms of what's the percentage of employees who are covered by various social security scheme, what is the percentage of people returning back from maternity leave, what is the gender diversity in terms of count of people, what are the aspects relating to appraisal of your employees, how much of your percentage of employees are subject to a performance appraisal. So it gets very intrusive in terms of some of the data, and so it becomes very relevant that what you call out is pretty much goes through a proper lens in terms of the accuracy of data, because all of this is in public domain as well. And some of this will have some interlinkages with, let's say, your financial data as well, in terms of your operations, your revenue data. There are also information sought in terms of related party transactions. So there is a bit of interplay between financial data, which is being reported by listed companies, and what is actually presented in BRSR as well. So this has come to stay. Last couple of years, companies have really gotten into it. There has been a method to madness in terms of how they collect the information and how they process it and report on it. But this has really come to stay, and this has kind of got its inspiration from some of the international framework like UNSDG and GRI that I mentioned. So some of these have been the basis on which this whole BRSR got it was the basis on which BRSR came up as well. So, as I said, BRSR assurance became a norm from last year. There was a glide path in terms of saying that the SEBI came up and said the top 150 companies by market cap had to get their BRSR core, as they say, out of the 140 odd questions, 40 odd questions, had to be subject matter of reasonable assurance. So it was a glide path to say top 150 by 2024, top 250 by 2025, 500 by 2026, and by 2027, the rest of the pack has to go through. So this is the glide path which was provided for companies to kind of get their BRSR data, subject to audit. It could be, SEBI also gave some guidelines in terms of typically, the audit committee has to, or the board has to look into the competency of the auditor, is there any potential conflict of interest, and then probably look into it. So the BRSR core, the 9 principles that I called out are typically, the ones that are on the right-hand side, which is on GHG gas, water footprint, energy, circularity of, waste management, enhancing well-being. So it's a blend of environment-related information and also employee-related information, and then also in terms of governance, in terms of some of the data as well in terms of privacy and customer-related supplies. So it's a combination of all of those is what is subject to audit. And I must tell you, having gone through a few of them last year, it is a very tough ask, because most of us would know that, financial information is a lot more mature. It goes through an ERP. There is a very clear process in terms of streamlined process in terms of reporting on data. But non-financial information is not that easy. I mean, it is, we've seen, different maturity pattern in terms of companies maintaining it in logbooks, companies maintaining it in ERP, companies maintaining Excel. So it's a bit of, shall I say, a mixed bag in terms of how the data has been housed and, managed. And so some of this brings in practical challenges in terms of putting in process controls in place, because these ought to be put out in public domain. Companies have to stick their neck out in terms of accuracy and completeness of the data. And so those are challenges that have emanated in terms of reasonable assurance as well. And we have, and I think taking cognizance of it, I mean, SEBI did come up with a consultation paper in terms of ease of doing business. They've tried to kind of dilute some of these aspects to kind of make it a lot more palatable, be it in terms of assurance. There is a thought to move away from assurance to assessment, third-party assessment instead of reasonable assurance, because reasonable assurance, as you would know, is like a true and fair view. A lot of companies on voluntary basis used to get it done on a limited assurance basis, which is like a limited review, which is a negative assurance, which companies get their quarterly reports reviewed and presented to the stock exchange. So there has been some thought in terms of kind of de-stressing it a bit because of the clear pain points that have come out in terms of reporting on all of those. But that's the consultation paper is yet to be kind of, shall I say, it's not moved any further. There has been, public opinion sought and comments have been received, but I think we're still waiting to hear from SEBI in terms of which way they will move. So some of the standards that, while from an Indian context, while in a global context, there is an ISAE 3000 and 3410, which are the most prevalent standards, common standards that have been used from an assurance standpoint. India has, the Institute of Chartered Accountants of India has a Sustainability Standards Board, And the Sustainability Standards Board also came up with two standards, which is SSA 3000 and 3410. These were mandatory for the following reportings from the right-hand side from the previous year onwards. So all companies which were getting their assurance done had to get it done under the framework of SSA 3000 and 3410. And now with and these are typically these two standards are, one is the 3000 is more a general standard, 3410 typically deals with the greenhouse gas emissions. So companies had to kind of get both of these. I mean, the auditors had to use both these standards to issue an opinion in terms of the overall data set that was put out for in the public domain. Globally, there is a move from shift to move away from both these standards into one single standard, which is ISSA 5000. That's going to be effective from period beginning 15 December 2026. That's a more comprehensive standard. It covers everything. You don't have two standards. It contains everything, and then that's pretty much a standard that's going to be there from an international standard standpoint. So I did briefly mention about the limited assurance versus reasonable assurance. I mean, I'm sure all of you would know what reasonable assurance. The rigor is more, significant. The intensity of audit, the kind of work that the auditor does in terms of providing a reasonable assurance is far higher than a limited assurance, because that's pretty much a review, and it's not an audit in itself. And so, to the extent companies had to go through this whole process, at least the top 150 last year, with regard to reasonable assurance on non-financial data. So some of the points based on what we've seen over a period of time, discussed with many people who have actually prepared their SR. I think the points to look out for typically is tone at the top and oversight of those charged with governance, because this is more a boardroom discussion today. There is obviously a clear fix in terms of who's accountable, who's responsible. So there's clear focus and drive from the those charged with governance standpoint. But also some of the other challenges that you actually look into, unless until that's done, it's not, it doesn't get implemented well. We've seen where it is kind of driven from the top, it kind of goes through a lot more seamlessly and in a more structured manner, as opposed to sets of people doing it on their own. Capacity building and talent and availability of expertise is one clear challenge that a lot of companies face. There aren't that many sustainability experts who are around who can help companies kind of report and provide some stability in terms of the reporting mechanism. I think that's one area where companies have been really focusing on in terms of capacity building. Looking into the ownership of data, because as I said, these are, again, a lot of times what happens, BRSR is, responsibility of a company secretary, because it goes as part of the annual report. Some companies take it in that sense, but it's more than that, because typically it is a combination of different data sets cutting across the organization, be it the human resource, environment, health and safety, distribution, a lot of those. So it has to be a group of people who are held accountable in terms of the data. And, typically companies have started creating an ESG committee at a management level, cross-functional committees, which kind of take care of some of these requirements. Where if you don't do that, then if it's left to one person's requirement, then it becomes a bit of a challenge, because there's no ownership that way. I did briefly allude to the fact that, the ERP that is in play, the companies have started looking into, automating. They're pretty much realized that, some portions of data are sitting in Excel spreadsheets. Some of them are in log manual books in terms of data that is being maintained. Some of them flow through the ERP. So companies want to make it a lot more automated, build in process and control to ensure that, a lot of data is, secure and complete in that regard. Again, of course, the last one is again automated and manual. And then also looking into process in place. These are some of the things that have really emanated as touch points for reflection as far as companies are concerned when they actually have started implementing BRSR. Slightly moving on to the value chain. Value chain is nothing but as a concept, it's basically upstream and downstream. So if a company operates, obviously it has an ecosystem where it has suppliers, it has customers. So typically customers are downstream and suppliers are upstream. So the requirements have, and any sustainability reporting, a company alone, reporting on their own operations doesn't make sense, because they are part of a large ecosystem. And so, unless and until you get a measure of the entire ecosystem in terms of what is their contribution to the environment, social, and governance, it doesn't make sense. So, a lot of global requirements have also been focusing on value chain. It's just not the company's operations in isolation, but also look at the value chain in itself. And so in this context, India has also really come up with, SEBI came up with their own requirements in terms of value chain reporting for the BRSR. So as we speak for March 2025 year, a lot of companies, top 250 companies by market cap, will have to also provide information on their value chain. And how does that go? How do they go about it? Is to typically take 75% by value of their purchases and sales, and then go back and then figure out top 75% of their purchase, top 75% of sales. Who are those vendors and who are those customers who are falling within this top 75%, and then they are to go and seek information on those BRSR core related information, which is typically on water, energy, emission, wellness of employees, the set of 9 core attributes that we saw earlier. So that's going to be a big ask as well, right? I mean, let alone getting your own set of data populated to go back and then get it from the value chain is going to be a very tough ask. So this is also one of the pain points that I think was brought out, and SEBI in their ease of doing business regulation draft, which is in draft, kind of called out to say is value chain reporting. Now it's on comply or explain basis, which is pretty much to say that companies do make an attempt to kind of get the data from upstream and downstream. Wherever they are not able to get it, they probably have to kind of explain what are the efforts they've taken and why it's not reported. But now they're trying to look at it to say that can we move to make it more voluntary instead of comply with the explain basis. So I think this is one of the very critical area where companies are grappling with in terms of value chain. And the reason for that is, if you look at it, if I have a very small vendor, I mean, how do I actually, do they have the same efficacy or the maturity in terms of capturing all the data in terms of water, waste, environment, all of those aspects which is required for a company to report? Do they and then this again is, if they are they are catering to multiple businesses, this data has to be what is attributable to your business. So then how do you actually determine what is attributable to your business if there are common employees or common efforts which are common costs being incurred for, carrying out their own businesses? It could also mean, in terms of the timing of availability. If you are a listed company and you are actually expecting annual BRSR to be sent out by May, seldom there are chances that the value chain may not respond accordingly. The value chain could be private companies, LLPs, proprietorship. Would they be able to give you this data before May? So then the timing becomes a bit of a challenge. Again, this has to be also subject to an assurance 1 year down the line. While in 2025, companies have to report, this data will be subject to an assurance 1 year down the line. And so effectively, is that auditable? And if so, how does one go about auditing? Because as a statutory, as an auditor of the company which is actually auditing the value chain data for the entity, they wouldn't have access to books and records of your downstream entities and upstream entities. So there are some practical challenges which are there. I think the ease of doing business regulations kind of factors some of this. Hopefully we will get to see the fine print in terms of what are the revised requirements of law. But until then, I think companies are gearing up today, because since they've not heard, we're already in December, companies have started looking into their top 250, checking with their value chain and asking them to provide all this information. So I wouldn't be surprised if you've received some of these requests from your own customers, your own suppliers, depending upon where they are in terms of the reporting aspect. Otherwise, you will sooner than later get them as well. So I did briefly touch upon the consultation paper. I think I did call out to say one of the two things that I probably did not necessarily cover in the in some of the slides when I was speaking is the 75% threshold. I think they're trying to dilute it to say, instead of looking at top 75% by value, if it's 2% on an individual basis, if I'm having a transaction as a company with a supplier or customer and my sales or purchases is in excess of 2% of the overall purchase on an individual basis, then you look at it, but then it goes up to maximum of 75%. And so they're trying to redefine so that the count of people that you ought to report in terms of upstream, downstream comes down. There's also a requirement to see if you can, there's a lot of these green credits that are being taken. So all of those can be disclosed as part of BRSR. So number one to BRSR to the extent I spoke about assurance, companies have realized, then figured out that, they have this in the exposure draft for public comments. They've also called out to say reasonable assurance in the context of an audit under financial statement audit is a lot more rigorous and may not be, fit for purpose at this point in time from an non-financial data. The expectation was not to have such levels of high rigor, and so should it be a third-party assessment in itself and a different framework being adopted. So that's still in works. We haven't heard much on it. And again, redefining value chain to say whether you move away from comply or explain to voluntary assessment. So these are some of the things that have come up in the recommendation paper, but it's worth the wait at this point in time, and we still yet to hear from SEBI on this. Some of the other regulatory requirements and, in terms of how, the other regulators have shaped up, SEBI did come up with a consultation paper in terms of making sustainable finance more inclusive in terms of the framework and the governance around it. Currently, it does cover specific aspects of debt instruments. The question is to see whether they should enlarge the scope to include social bonds, sustainable bonds, and sustainably linked bonds as well. So this again was out for public comments. SEBI has received the public comments. They need to come back to regulate in terms of all these debt instruments that are being brought in from a sustainable finance standpoint, and how does that get governed. Typically, if you see a lot of companies, just like your financial statements are subject to a rating by CARE, ICRA, and many other agencies today, sustainability indicators are also rated by many companies, many rating agencies. There are global rating agencies like MSCI, Dow Jones, Sustainalytics. All of them get a lot of companies rated on their sustainability indices. And that becomes a bit of a key talking point, because it kind of gives you the good, bad, and ugly about your own operations. And so, to that extent, companies are very mindful of the ratings that they get. And in the Indian context now, SEBI wanted to regulate and bring in some harmonization and uniformity in terms of the rating agencies. And so they brought in regulation to say, if someone in India is going to rate Indian entities, they have to be registered with SEBI. They've got in a mandate around that. And there is a process to be looked into in terms of companies which are subject to a BRSR core assurance rating agencies look at it. So there is a bit of harmonization and standardization so that it becomes a lot more comparable when the rating agencies come out with their ratings. Then the other one is also in terms of assets under management, ESG funds. There are a lot of ESG funds, I'm sure you would note. Mutual fund players have come up with ESG funds as well. So SEBI has again kind of mandated that if any fund manager, if they are actually floating a fund in terms of ESG funds, 65% of their assets under management has to be subject to investments in those entities which have got a BRSR assurance stamp. So if the data is assured, then it makes a lot more sense. And so they've been very specific in terms of guidance in terms of ESG funds, where those funds are going to invest. Let's say if it's in Infosys, Wipro, or any other company, they will have to be mindful that 65% of the portfolio should be in those companies which are subject to an audit. So that brings a lot more credibility in terms of the underlying investment. Last but not least, RBI again had come up with their own requirements in terms of climate risk. So all the regulated entities, this is again in draft, it's in public, it had come for public comments as well. It is pretty much aligned to the climate risk related global framework, where RBI has come up with their own risk related assessment in terms of calling out that all the regulated entities, again, it's got a glide path in terms of which are the various entities, be it NBFCs and others, when do they become applicable for them. But then this pretty much caters to companies doing their own assessment in terms of climate risk, in terms of their own portfolio, their own entity standpoint, how do they perceive climate risk, and what are the checks and balances that they have, what is the governance mechanism they're going to put out. All of this has to be disclosed by all these regulated entities as far as the RBI consultation paper is concerned. So largely, I would say these are some of the moving parts in terms of reporting requirements in India. It's really caught on, much more than, and a lot more intense than what many people thought. The amount of work that goes through providing all this information is fairly intense. And of course, this is going to evolve further, right? I mean, this is just the start of it. While it may get simplified as we go along, depending upon the feedback from the industry at large, but it is an evolving piece, and then it will kind of get consolidated over a period of time. Thank you again for your patient listening, and happy with the questions. So the first question is, what are the key challenges organizations face in aligning sustainability reporting with evolving ESG compliance standards, and how can CFOs address this effectively? So typically, some of the challenges I did kind of call out. From a CFO's lens standpoint, I think if you step back a bit, I think ESG reporting in itself is the last leg of the entire value chain, right? I mean, companies do start setting out ambition in terms of what do they want to do from an ESG. Or let me take a step back. I mean, there are, I would say, two sets of views in terms of looking at ESG purely from a compliance standpoint. There are companies which, for whatever, I mean, there's no right or wrong answer in this, but there are companies which want to kind of look at it at a bare minimum compliance requirement. And so they pretty much want to meet the requirement of law and report on whatever is asked for. There are other bunch of companies which look at sustainability from a broader lens, looking at it to say that how does it actually get integrated into a business strategy, how does it embed itself in my ways of working, and hence consequently kind of strategize how do I go about looking at sustainable matters. So it again boils down to which part of the which side of the spectrum are you in. If you're pretty much a compliance thing, all you would be wanting to say is, look, how do I get my bearings right in terms of looking at the process controls, the data that goes out in the public domain, right? So typically a CFO's nightmare would be to say, is the data that goes out, is it right or wrong? Would I have a restatement next year down the line because there is some error that creeps in? Do I have the right checks and balance in play? Who's taking ownership for data? Because a lot of this data could be non-financial data, or not necessarily which a CFO may be aware of, right? A lot of this relating to carbon, relating to water, all of those are pretty scientific data, which is not necessarily something which is a forte of a commerce graduate in that sense. So typically you would see that the checks and balances becomes very important. So from a compliance standpoint, I think give or take, it boils down to putting a right process in place, looking into whether you have the adequate set of people to kind of competent set of people to kind of handle each of this requirement, and then how does it get reported? Where does accountability lie? And again, goes back to also the level of automation, level of capturing of data, what is the efficacy of the process in itself in terms of capturing the data. I would think those are some of the key things that challenges I would feel. Of course, as I also said, talent is again a very significant challenge today. You don't have too many sustainability experts. You may have them in the sustainability segment in terms of some experts on environment, on waste, water, but to kind of cross over and get into the reporting function, those sets of people to know the reporting, I think it's a bit of a challenge. So you've got different skill sets, you have to map them. I think these are some of the challenges I would think the CFO kind of goes through in terms of from a reporting and compliance. The next one is how can CFOs ensure that sustainable reporting not only meets regulatory goals, but also enhance stakeholder trust and drives long-term creation? So that's a great question. I think it goes back again to your tone at the top, right? I mean, a lot of times you would now come to see, and we are coming to see that the ownership goes right up to the board of directors. And unless until it starts from there, you would not see it percolate down to different functions within an organization. So a CFO can be a good catalyst in this whole process because as part of executive management, they probably drive the implementation part of it, of the vision that is being set out by the board of directors. Or discussed and the strategy that has been kind of called out and approved by the board of directors. So a CFO's role is to kind of ensure that he or she acts as a good layer between people who are implementing and people who are actually overseeing. And so that's where then this whole process of ensuring that sustainability is done from a sustainability lens and just not from a compliance lens kind of can be met. What role does technology and data analytics play in improving the accuracy, transparency, and efficiency of sustainable reporting process? Certainly, I mean, I'm sure every challenge is an opportunity, right? So if companies are facing challenges, you see a lot of tech companies come up with so many tools and probably enhancing their own modules in terms of existing systems. So there is always an opportunity, and it's probably a very relevant, pertinent opportunity because today companies are moving away from just, and especially if you are a CFO or you are in the finance function, you would know the essence of data, right? You would know the value of data. And so, while, I mean, there's nothing, in terms of the maturity of data, in terms of how the data is housed, how the data is harvested, I think all of this is pretty much a bread and butter for finance function. Because we pretty much go through a grind of audit, grind of reporting, so that's a lot more, and because a lot of information goes out in public domain, so there's a lot more maturity in the system. So I think data becomes very relevant in terms of even analyzing the data to say, looking at it from an, let's say, a comparison to say, does it make sense? Does it meet the smell test? So a lot of those analytics gives you a clear, even if you're not a subject matter expert, but doing some of these analytics in terms of looking around, bringing a correlation between, an indicator with another benchmark, be it revenue or production. I mean, it gives you a bit of flavor in terms of how do you look at the, how do you kind of come to a conclusion whether the data looks fine or not. And again, similar with technology as well, because technology again is very important. It cannot be overemphasized. But again, people are looking at it in terms of stages, right? I mean, not all of them are just running into an ERP, high-end ERP on day one. They're probably also looking at off-the-shelf packages, trying to scale it up because your process and controls have to be, mirroring the transition. It's just not the technology alone that will help you solve the problem. It has to be a combination of putting process in place, putting controls in place, and then embedding into the technology. I think companies are in their own maturity curve and their journey in this regard. Some of them have in a more advanced stage, while some of them are in very formative stages, and some of them are in between, I would say. These are the questions that I had. Thank you. Thank you, Dan.
Thank you, Mr. Arun. I think a very, very complex topic, the last one, but I think he kind of summarized everything very nicely and brought it out within about 45 minutes. The real challenge was that for him, actually. Now I request Group Captain Vijay and Mr. Suresh to come on to the dais for one more last time today to present the memento to the guest speaker. Also, a great audience. I think all of you have been sitting through the day and, applauding all the speakers. You've been very, very attentive. Thanks to all of you. Thank you so much, Mr. Arun. So there are two authors standing behind the speaker. The books that are presented to them, one is written by Mr. Suresh, the other one is put together by Group Captain Vijay Kumar. So, big round of applause to them as well for being authors. I request Mr. T.G. Suresh to propose the concluding remarks, and then we will have the national anthem before we depart.
So because I took the vote of thanks in the inaugural address of Captain, I thought he will relieve me from this. But however, he said, no, you ought to give it. The very fact that so most of you sustained till 5:15, there is a clear value creation. So that's the topic, sustainability and value creation. So, very honestly, I always used to sit here and give lecture. I've never been a recipient. To my knowledge, this is the first time from 9:20 to 5:15. Most of the time I'm in the listening part, but I'm sure all of you will agree with me. We all carry tremendous insights and a wealth of knowledge. You agree with me or not? So, absolutely, as Arun was also mentioning about, definitely there are some moments when Jagan was talking about a lot of butterflies. சாப்பிட்டதுனாலயா இல்லை இல்லையான்னு தெரியல, அந்த மாதிரி அப்படியே ஜெகன் அப்படியே பயமுறுத்திட்டே இருந்தார் அப்படியே ஆக்சுவலா. But however, every challenge always comes with an opportunity. I'm sure 2025, if you're just even able to take 25% of this, most of you will agree with me. But you are entering 2025 with a world of opportunities. Of course, every challenge comes with an opportunity. Every problem comes with an opportunity. All of us must understand, the problem need not necessarily have to be your problem. SEBI, RBI and other to create problems for somebody. So that becomes an opportunity. So I will be feeling duty if I don't show my gratitude to all the speakers. See, most of them, like they don't have the time. In fact, so it's very difficult to even to get them. I have to put WhatsApp, we have to wait because we're extremely tight. But with all these things, they come here and they were sharing their practical experience insights. It is not a very, very theoretical academic program. I would have seen when Desikan was discussing about how they practically implemented. So I'm sure that the one before the lunch was absolutely, very honestly, I know MPV for a substantial period than most of you. And generally his topics were used to be pretty serious. In fact, I used to be in many of his team meetings or many of his election campaign only for one reason, to make the team lighter. Today I was extremely delighted to find this 1 hour was full of joy only. It's quite, and it was also a very complex topic. And of course, what is there in store for our future. And all the speakers were great, amazing. And during the break and lunch, a lot of people asked me one thing. When are you going to organize one more program like this? And there is nothing else a better testimony than this, because when you have a great speakers,
great topics, 250 plus registrations for this kind of a topic. I think it all goes to the grave participants like you. No program can be successful without a participant. We can do anything, but without you being there, what will you do? And look, at 5:15, Arun was thinking that 5:15 he can walk off in 2 minutes time. But on the 5:15 கூட வந்து questions நிக்கவே இல்லை. So that's a kind of amazing delegate you are. I think all of you deserve such a very, very big hand for being such a wonderful delegates. And I think நம்மளே நம்ம தெளிக்க வேண்டியதான். So okay. ஒரு ஈவெண்ட்லாம் பண்ணும்போது பார்த்தீங்கன்னா இட்ஸ் மோர் லைக் டூயிங் எ மேரேஜ். அஃப்கோர்ஸ் அவர் டீம் would have called you, MMA team would have called you. No, organizing tea, coffee, food for 250 plus people is not easy. We would have sometimes troubled you and other things, but there's a lot of effort goes into this program. Is நிறைய பேர் சொல்லுவாங்க ஆக்சுவலா வீட்டை கட்டிப்பார் கல்யாணம் பண்ணிப்பார். நான் ஒன் மோர் ஆட் பண்ணிக்க ஒரு ஈவெண்ட் பண்ணிப்பார். பட் இவங்க டெய்லி பண்ணிட்டு இருக்காங்க, அது அடுத்த விஷயம். பட் இட்ஸ் a very extraordinary task. But in the process, of course, captains, CFOs, no, but there are a lot of people behind us, right from flowers to putting the name board, all those things. The MMA team has been doing an extraordinary job. All the people behind, right from my side, everything. There are a lot of people behind it. And of course, from SAPRO team, they have been working for the last 1 week to call you, just meet you, message. And of course, the PKC team. So everybody support. But the one thing which I would really like to highlight is these kind of programs. The moment I shared this event with PwC, they immediately said, we would like to be part of this program. Thank you, Pradeep. Thank you, Baban. You have been a very, very big support for this program. The program of this cannot be done without a support like people like PwC. Thank you, but I think the MC of today, marvelous, amazing Venkatji. நான் வந்து லாஸ்ட் இயர் இங்கே ஒரு ஈஃபா ப்ரோக்ராம் பண்ணும்போது நான் வந்து கேப்டன் சார் இங்கே எம்சி ஆர்கனைஸ் பண்ண விட்டேன், அவளே கூடாதுங்க சார், எங்கள் ஆள் வந்து எந்த டாப்பிக்கில் வேணால் பேசுவார் எம்சி அப்படின்ட்டு. சார் சஸ்டைனபிலிட்டியும் பேசுறீங்க, இன்டர்நேஷனல் டாக்ஸும் பேசுறீங்க, எங்கள் ஸ்கூலுக்கு வந்து பயங்கரமாக ஹெல்ப்பும் பண்ணுறீங்க. சான்சர் சார். ஸோ ஐ திங்க் யூ anchored the program beautifully. So thank you very much all. I'm sure looking forward to one more great event shortly about the CFO forum. I think you can learn. I don't want to stand between you and your Saturday evening. So of course, in fact, he gave me only 2 minutes time. Sorry, exit item. Sorry. Thank you very much. Fantastic. I'm sure all of you will go with the wealth of knowledge.
Ladies and gentlemen, thanks Mr. Suresh for putting this together. Let's rise for the national anthem.
जय गण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल गंगा विंध्य हिमाचल यमुना गंगा उज्जल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगल दायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
Then tell them it's all available on YouTube and other
Yeah.
channels, they can watch it.
So thanks once again. We have the tea laid out for you. Please have tea before you leave, and if possible, please give us the feedback about the session as well. Thank you, sir. Thank you so much, ladies and gentlemen. Once again, have a great day. Have a great weekend.